Hi, good morning, guys. Morning. So, welcome to SPMBB class. Yeah, CMA Vidyarthi, good morning. Good morning, guys. Good morning. Evan, good morning. So, then, okay, guys, we will start our session. So, first thing I already told in our YouTube video, it is the easiest and good scoring paper we have. Okay. So, when coming to all, comparing to all papers, we have a little bit of strength for this paper because we can easily crack 70-80 marks. The scoring of 70-80 is not that much of easy. So if you score that much of marks, automatically you can crack your either group 4 or both groups. It's helpful for aggregate as well as sometimes it will give a strength to rank. Okay, so that's why when coming to paper 20, previously it is only single paper. Now our board announced paper 20 has a 3 branches optional paper. Paper 20A, 20B, 20C. Okay, when coming to out of these 3 papers, paper 20A is our paper called SPM and BV. So remaining 2 papers, it relating to startups and it relating to risk management of banking and insurance sector. So this startup paper and risk management paper both are theoretical papers. When coming to our SPM BV, it is a hybrid paper. It includes theoretical portion as well as problematic portion. Comparing to theoretical portion, maximum we will get at the problematic portion most. 80% of marks we can easily gain from the problematic portion. So that is the advantage we have. So lack of understanding, lot of students are picking that paper 20B and 20C. I'm always suggest that please pick paper 20A SPMBB. Why? Because it linked to SFM, SEM, CFR. Are you clear? So if you thorough about SFM, SEM, CFR without preparation, without listening of SPMBB classes, you can crack 40 marks. That much of strength we have in this paper. So when coming to why we have to choose my classes means, so I prepared my own material with a lot of efforts. I considered lot of materials, lot of past papers, MTPs, all models I covered. When coming to exam point of view, model as well as problem involved in our textbook will be same. When coming to remaining subject, model will there, they will give a different problems. But when coming to the beauty of SPMBV, what are the problems you learned in our material, same problems will get. Okay, next another point, when coming to lot of my students are expecting for me as a marathon session. So in marathon I will cover only 11 to 12 hours content. In that 11 to 12 hours content, that not much easy to score 60. So my suggestion, please purchase EO classes. Why? Because it's money is not a barrier for this. Why? Because 30 to 35 hours I will explain all concepts, problems, and case studies, MCQs. So when coming to recent times, they are giving case study based questions. One is MCQ point of view, another one is a theoretical point of view. When coming to, you know that 15 MCQs there now. Out of 15 MCQs, they will ask individual MCQs 10. After that, they will give a paragraph of a case study. They will ask 5 MCQs. Okay. For last attempt, only from chapter 2, performance improvement tools, they're asked 40 plus marks. If you learn that only chapter, you are pass. Hope you guys clear. As well as there is a no fixed pattern for our paper. When coming to in every paper, they have some fixed patterns, right? When coming to our paper, you can observe this. Last 4 attempts patterns. In this 4 attempts pattern, only few are the, wait a minute. Only few are the similarly they're asking. But when coming to in June 23, they're asked a lot of questions in chapter 1. In December 23, they're asked a lot of questions from chapter 7. In June 24, they're asked a lot of questions from chapter 6. In December 24, they're asked a lot of questions from chapter 2. This kind of pattern they're following. Hope you guys clear. So when coming to check this December 24 paper analysis. So this question number 2A, the slot is fixed, guys, from chapter 1, SPM. Okay, we have a few concepts. If you thoroughly about that few concepts, you can easily crack that question number 2A. Okay, just one attempt only they skipped from chapter 1. Remaining all 3 attempts, they're asking chapter 1 question only. In whole syllabus also, this is a pattern they followed. When coming to question number 2B, guys. So in first attempt only, not first attempt, in every attempt they're asked chapter 2 theory question. The slot is fixed. Next, when coming to question number 3A. So this also we can fix, guys. Only one attempt they skipped the chapter 3. It is a very important, easy and important concept we have. In SCM, there is a topic called economic efficiency calculation. Derivatives. The same entire calculation is given here also. Same calculation. There is nothing is changed. It's a mandatory question you will get. 3A. Economic efficiency problematic portion from SPM. Next, when coming to question number 3B, guys. Chapter 4. Theoretical question. When coming to question number 4A. I can't assure this, but last 3 attempts they are following the same pattern. Chapter 2 problematic portion. These are about the theoretical portion called SPM. In BV, 100% problems is there. But when coming to the SPM also, we have a problems as well as theory. Okay. Now, this question number 2 also very, chapter 2 problem also very easy. There is a concept name called two-point analysis. Return on equity calculation. So we have a different models to calculate that return on equity. If you understand that concept, you can easily crack. The only thing you have to focus presentation. Are you clear? All are basic calculation, but you get an answer within 2 or 3 lines. With help of the 2 or 3 lines, you can't get 7 marks. That's why you have to write entire theory content properly. After theory content, you have to calculate that. After calculation, you have to say decision. That kind of presentation is required. I will help you to help you for a presentation purpose also. Next, when coming to chapter 4, question number 4B, guys. From chapter 4, problematic portion. It also dead and easiest problematic concept. Easiest concept we have. There is a concept named called Altman G score. Okay. Out of not only this new syllabus, in old syllabus also the slot is fixed. Okay, but the issue in last attempt is there is one concept name called Benish M score. So that is not that much of important. It is a C category concept. As a faculty, I am not suggesting that because that is a very complicated question. But last time they asked that question. Okay, so we are not ignoring any concept in SPM. Problematic question point of view. Why? Because in a basic concepts also they will give for 7 mark questions. When coming to BV portion, up to 4B, we have completed SPM portion. Now we are entering into BV portion. 5A. So maximum you will get from chapter 5, guys. So basic concepts like in your FM, cost of capital chapter is there, na? Cost of capital, capital structure, leverage, that kind of basic problems they're asking. So they're asking a question, case A, case B, case C. For case A is easy, case B moderate, in 5 question number 5A only we have a 3 options. 5A calculation, or you mean A calculation, B calculation, C calculation. A easiest, B moderate, C we can't touch. For observation, it is a basic problem. But if you involving that problem, it has a lot of strength is the other problem. I will give a clarity for that kind of problems. Next. When coming to 5B guys, when coming to the 5B, June attempt pattern is different. First attempt, June 23. There is no fixed pattern for the June 23 attempt. Remaining all 3 attempts, we have a same pattern. So the gap is because of a pattern not same as a first attempt. When coming to 5B guys, you can maximally expect this chapter 6 problem. We have a multiple methods we are using for calculation of valuation. On that methods, they will ask a different method for every attempt. When coming to 6B, maximum of the cases you will get from either 6th chapter or 7th chapter. There is no fixed pattern. Hope you guys clear? Next, when coming to the 6B, here also be same. It's a combination of 6th and 7th chapter. We can't expect which chapter it is. Next, when coming to this 7A, from chapter 8, name called mergers and acquisition. It is the easiest chapter we have. Why? Because there is a basic calculations are there, EPS calculation, MPS calculation. Every problem, these two are same. In addition that, 1 or 2 points they will add newly. So for every problem, EPS, MPS is common. For you have to understand the new points in the multiple problems. If you know that new points, you can easily crack. Why? Because in a old syllabus, if you learn only mergers and acquisition, you will get 30 marks in old syllabus. But that kind of assurance I can't give for this new syllabus. Every attempt they will change the pattern. But I will give assurance you will get 20 marks from this chapter, mergers and acquisition. Next, question number 7B, also from chapter 8, mergers and acquisition. Question number 8A. So you can observe two abnormal things here. What? Case study based questions for 7 marks. When coming to 8B, as usual, mergers and acquisition. Are you clear? So when coming to our syllabus point of view, SPM at the rate of 50% syllabus we have, PV at the rate of 50%. So our chapter 1 guys, introduction to performance management. Chapter 2, performance evaluation tool, improvement and measurement tools. Chapter 3, economic efficiency of firm, are also be known as performance analysis. Chapter 4, enterprise risk management. When coming to BV portion, chapter 1, fundamentals of business valuation. Chapter 2, valuation method, not go with the order. Chapter 5, chapter 6, valuation methods and approaches. Generally, as per your board book, order is different. SPM order is same. When coming to the BV order, chapter 6 is law and compliances. That is an unimportant chapter we have. Up to this much of attempts, we are not getting single mark from the chapter. It also be relating to law subject. Hope you guys clear. Now, that's why I changed the order from that law and compliances. I sent it to last chapter called chapter 9. So next, chapter 7, valuation of assets and liabilities. Chapter 8, mergers and acquisitions. And the chapter 9, the new chapter called law and compliances. Are you clear? Done. Now another advantage we have, these two chapters is there now, fundamentals of business valuation and methods and approaches. In your board book, you have a huge confusion. Why? Because basic concepts in chapter 5 as well as chapter 7 as per board book. Very clear. But for understanding of the student, I sent all basic concepts to 5th chapter. All advanced concepts to 7th chapter as per board book, 6th chapter as per my book. Hope you guys clear up. Now, without it, I start chapter 5. So what is the chapter 5, guys? Fundamentals of business valuation. Abid, hi Abid, and Anant, good morning. Bhaskar sir, good morning, sir. Sir, one point I need to note here for YouTube live students. I will conduct only half day live, sir. So you know that SPMBV is not that much of a syllabus. That's why I will close my live afternoon session. If you want further classes, you can purchase on our online app, sir. Okay, so let's just understand the topic of valuation. So take an example. It's a transaction between a girl and boy. So after a few days of love and affection, they got breakup. So on that time, she told that you don't know my value. You will realize one day. Even I don't know how much the value that is. Hope you guys clear. In every transaction, we are using a word called value, but we are not assured. Can't say that how much it is. As a final aspirant, now we are learning that calculation of value. Hope you guys clear. In a simple sentence, valuation means ascertaining something or fix a value to something. Hope you guys clear. As per law also, human emotions don't have some legal criteria also. I hope you guys clear now. But when coming to our portion, we are not valuing human emotions. We are valuing something is there now. That something is nothing but either asset or a liability or a business. Clear? So that is called valuation. A simple sentence, we can easily crack that entire business valuation principle. Value ascertaining something or value fix up something. The something is nothing but asset, liability as well as business. Clear? Okay. For fixing that value or ascertaining the value, we have a multiple methods is there. Multiple approaches is there. Hope you guys clear. First, we have to understand the approach. After understanding that approach will give methods. With understanding of the method, you can easily calculate. Very clear. Before that understanding of the approach, you have to learn the fundamental things of the valuation. Why? Because valuation is not that much of easy. Hope you guys clear. For every company, there is a transaction between two companies. The transaction is plant and machinery. One company is selling the plant and machinery to another company. Y company is selling plant and machinery to X company. X company also have a CMA student as well. CMA CEO he was a. Y also have a CMA. He has a knowledge of valuation. So Y company CEO calculated one point of view. X company person calculated another point of view. So okay, clear. Automatically, if they sit and together talk each other, the values are not similar. Why? Because they have followed different principles. Very clear. Valuation is a subjective concept. There is one sentence is there. The subjective concept means value is differ from person to person, place to place, time to time. But we are using a word called valuation is different from valuer to valuer. Why? Because we don't know. It involves judgment, experience, knowledge. Everyone has the same don't have the same knowledge now. Everyone don't have the same experience. Everyone don't have a skill. Same skill. That's why there is a difference is there. So how it possible to value means it's purely based on negotiations. We can sit together. We can say what kind of principles are used for that valuation. He will explain what kind of principles they're used. After discussion of that, we can quote that word. So just like a bargaining now. I want this machinery for 10 CR. He is told that no, 12 CR. After that, they will come to 11 CR. That is called valuation. Hope you guys clear now? Done. See, so this great personality, Tata ji. So he acquired Jaguar and Land Rover. So just imagine Tata point of view. There is some disturbances in that Jaguar and Land Rover issue with Ford. Once upon a time, he presented some car to Ford. They told that why Indians are doing like this kind of works. You are not deserve this. That kind of words they're used in Ford company management. After 10 years, I think Tata Ji purchased that Jaguar and Land Rover. Now he might, you know, that he already say this, but he can't say I want this company for this much value. With words I can't express. I will appoint my team, they will do valuation, based on that value only I will transact to them. Hope you guys clear up. So just by words we can't purchase the companies. With help of figures only we can purchase. That figure is nothing but valuation amounts. Very clear. Next, this guy also, you know, that Elon Musk, he purchased X, previously known as Twitter, I think. Now he purchased at October 2024 44 billions. 44 billion. 44 is not a rough figure. It involves lot of calculations is there, lot of valuation methods is there, lot of principles is there. By using all those things, they calculated 44 is a worth to Elon Musk. Hope you guys clear. Now why that 19 billion is there now? I think there is a today value. Not today, it's a future value. So he purchased for 44 billion, but as the time of 23, I think last year, the value is 19 billion. So every time to time you have to calculate how much value company have. Hope you guys clear. Done. Next. So when coming to valuation, I already told the basic definition. Why? Because our definitions are not required for problematic questions. So valuation means ascertaining value to something. That something is nothing but what, guys? Either business, asset, liability. So there is no calculation of liabilities. There is a lot of calculations relating to business, entire business valuation or asset valuation. Next, when coming to valuation is a subjective concept. What does it mean by subjective concept? It's differ from valuer to valuer. Value is differ from valuer to valuer. Why? Because it involves professional judgment, it involves opinion, it involves experience. For understanding of this sentence is a very important sentence. For example, there is a building. I am the seller. I quoted 50 CR. What is my bid price? I will sell my property for 50 CR. What's your name? P Limited is purchasing that one. Now the P Limited saying that property is not that much of worth. I will purchase for 45 CR. Are you clear, sir? Or no, go with the 30 CR. Why 30 CR means he was using that property for residential purpose. It will not generate future income. That's why he will quoting less amount. So what's your name? Yeah. So Tamil Selvi is another purchaser. He quoting that I will purchase that property for 55 CR. I am saying that mad or what? They are ready to sell 50 CR, but you are quoting that 55 CR. It's a wrong now. No, Tamil Selvi is saying that it's a right. If I purchase that property, my future economic benefit is more than 50 CR. Are you clear? When coming to this Pugan, he is saying that if I purchase that property, my future economic benefit is not equals to 50 CR. That's why I'm quoting less. Only one property, three different values, three different valuers. Hope you guys clear up. Now see, professional judgment is involved, opinions are involved, and experiences are involved. Okay, done. Next point you have to understand, valuation happen at a point of time. The word a point of time means it's a talks about years, not it's a regular transaction. Regular, it's not a regular transaction. It happen at yearly once or 2 years once. That kind of word is called a point of time. Next, another important basic points you have to learn, value is different, price is different. Are you clear? This value and the price difference I understand in economics foundation level. There is a concept name called water diamond paradox. Water diamond paradox. So in the water diamond paradox, what they're saying means, they're saying that water is a less value compared to diamond. But if it's a crisis, what happens? Automatically value of the water increases enormously. Sometimes it will sold for more than diamond. That's a water diamond paradox theory. Now the saying of the water diamond paradox, value is different, price is different. What we get is called value. What we pay is called price. Are you clear? When you are getting, you are receiving your price as well as benefit. When you are paying only price. That's where the difference is there. Now see, value is based on the principal name called value in use. Based on usage only we can decide the value. When coming to price, it's based on exchange. If there is a more demand, we will increase the price. If there is a less demand, we are decreasing the price. Are you clear now? Next. So what are the methods we are using for value calculation? Economic value as well as market value. So these all are helpful for MCQ guys. Next, when coming to the price point of view, price we are deciding based on demand and supply guys. Price we can fix based on what? Demand and supply. How sir? How? The common sense, as a manufacturer of mic, if my product have a huge demand, as a manufacturer what I do? I will sell for low prices or high prices. My product have a huge demand in the market. As a manufacturer, I sold my mics for high prices or low prices? High prices. As a manufacturer, my mic demand is less. I have a lot of finished goods. For selling of that finished good, what I do means I will reduce my price. Are you clear now? The price purely based on what guys? Demand and supply. I will give you more clarity in chapter 3. It's a purely economics, entire economic subject in single chapter. Next, valuation need a more subject knowledge. What kind of subject knowledge we require, sir? First, you have to understand business environment, guys. What nature of business they are doing. They are service sector or manufacturing sector or banking sector. That kind of understanding you have. That kind of understanding you can get in SPM subject. Next, law and tax compliances. Law and tax compliances. You have to learn law subject as well as Bhaskar DT subject. When coming to accounting framework, I already told now it's linked to CFR. Next, time value of money, it related to your intermediate financial management, as well as some spreadsheets that is nothing but max. If you know all those things, you can do valuation. Okay, but when coming to exam point of view and calculation point of view, we are not showing this much of knowledge I have. Okay, we will just calculate based on the method. Are you clear? Done. Next, so very important point guys. Purpose of a valuation. Without purpose we can't do anything, right? The same thing here also. We're doing a valuation means you have to give a explanation for that valuation. That explanation is nothing but purpose. Why you are doing valuation? Why you doing value of that asset? Why you are doing that value of college? Why do value of that business? You have to provide a purpose. Please give some purposes as you know. Anyone? You are a valuer, you're doing a valuation, either asset or a business. Without purpose, we are not doing. I want, what is the purpose we are doing? What's selling and buying? So selling and buying, the common point is there. Seller also need to know the value of that one. Purchaser also need to value of that one. Why? Because we can't give for words. I already told, we can't express in words. We need to express in amounts, rupees figures. Buying and selling. Okay. Any other option? Any other purpose? What's it? To invest. There is nothing but purchase, guys. Purchase. Exactly. That's a point you have to understand. IPO. So if you want to sell your shares in an open market, you have to understand how much worth you have. If you know only, you can quote that price. Yes or no? No? You have to give a price. This much of my share price. How can you decide? If you know the value, then if you divide it with the number of shares you are providing to an open market, you will get a market price. Yes, exactly. Next. Next. What guys? Liquidation. Nothing but selling, but liquidation is different. Very clear now. At the time of liquidation also you have to learn, you have to understand how much worth I am. It's selling this much of amount is a good or bad. Next, what guys? Merger and acquisition. Okay. The proper and professional word is merger and acquisition. Selling and purchase. Okay now. The professional word is merger and acquisition. The commonly we are using purchase and selling. Next. So you can observe some more new topics is there. Merger and acquisition you already told. Liquidation you already told. Trade disputes between the partners. Retirement of the partner, death of the partner. On that time also we need to settle the money to partner. Na? At the time also if you are settling means you have to learn, you have to know how much I need to settle. How much I need to settle at the time, you have to understand how much the total value. Next, buyback. Shares buyback point of view also. Next, you already told initial public offer, selling of shares. Next, estate planning. It's about for any property provided by forefathers. If you're selling that transaction, that is called estate planning. Next one, slum sale, sale of asset lump sumly. Next, business reconstruction. Are you clear? So these are the purposes we have. So helpful for your MCQ. Even though we have a multiple purposes, we are doing evaluation in this subject for only the reason name called merger and acquisition. Next. Wait a minute. So these all are about the theoretical content regarding the valuation. So when coming to the valuation, you have to learn fundamental base, assumptions, principles, conditions, concepts. So this concept is nothing but calculation part, that is called methods. So I am not discussing these methods in this chapter 5. You have a only chapter 6 entirely cover these methods, approaches and methods. Now, so this entire discussion is known as valuation premise MCQ. So valuation premise means you have to learn fundamental base of the valuation, assumptions, principles, conditions, methods. The aggregation of all those things is known as a valuation premise. Next, when coming to the valuation, guys, we have a 3 approaches. One is called market approach, another one is called income approach, another one is called cost approach. So every time of valuation, you have to pick either market approach, income approach, cost approach. Sometimes some people will focus on all. Sometimes they will focus on only 3. The reason is based on the availability of the information. If you have a market information, you can use market approach. If you have a income information, you can use income approach. You have a cost information, you can use a cost approach. Okay, done. My point of view, I have one question for you. For this college, what kind of transactions you are consider for valuation? How you value this college? Number of students. Based on that, you are doing evaluation. Okay. Only you are considering number of students. Number of subjects. Okay, electricity. Main thing is there. Faculty salary. Faculty salary. So you are considering from student point of view revenue, you are considering management point of view cost. By using these 2 amounts, you are doing a valuation, right? Yes or no? That is called income approach. That is called what, guys? Income approach. Are you clear? Why? Because of it's a service sector. We can't do value with help of assets. By calculating of fans and chairs, we can't do valuation. Yes or no? But when coming to the Tata Steel companies, if you have a chance to value the Tata Steel company, what kind of transactions you were considered for valuation. Plant and machinery. Why? Because on that case, we have a multiple assets is there. Based on assets, you are doing a valuation. Yes or no? No? That's why we have multiple methods based on the I already told now subject knowledge required business environment. Based on that business environment, we will decide which approach is suitable. On that approach, which method is suitable. Okay. Now, when coming to the market approach, guys, in market approach, you have a 3 methods. One is market price method, another one is company comparable multiple method, another one is company comparable transaction method. Every method have some lot of discussion is there. Based on that method, you have a problems. You will get a more clarity in chapter 6. I will give you full clarity. Just as of now, understand the methods we have as per market approach. When coming to the income approach, guys, you have a 2 methods. One is discounted cash flow method. Another one is earning capitalization method. When coming to the cost approach, so Varshil, sir, can you watch live on regular basis on YouTube? No, guys. It's only for afternoons, up to afternoon only. After, if you want these classes, you have to purchase on our app. When coming to the cost approach, it classified into another 2 methods: replacement cost method, reproduction cost method. So you have a multiple problems, all these methods except these 2. You don't have any problems regarding that cost approach in your board book as well as old sources. Next, in addition that, we have another methods. They are not covered under approaches. So net assets value method, economic value added method, market value added method. So these 3 methods are not covered under approach. Are we guys clear? So they can frame a MCQ like this. Which method is not covered under approach? Yes or no? No? Done. Now, when coming to, these are the theoretical knowledge you need for valuation, guys. I hope you get a aura of that valuation theoretical knowledge. Okay, the soul, you understand now what is a valuation. Now, when coming to the calculation part of chapter 5, this all are CMA inter topics. So CMA interrelated topics for valuation. You done a valuation in your CMA inter level only, but we don't know on that time there is a valuation. So you know the formula of KE calculation. KE equals to, there is a 2 concepts is there: without growth, with growth. When coming to the with growth, T1 divided by P0 plus growth. This is the formula we are using for KE calculation. Now if some questions is there, they are asking P0, not KE. But with help of this formula only, we are figuring out the P0. So P0 equals to T1 divided by KE minus G. This is the way to find out P0. What is meant by P0? MPS, market price per share, into number of shares. What you will get an outcome? Market value of equity. This market value of equity is known as total point of view. This MPS is known as per share point of view. Both are valuation of it. Are you clear? What are the calculation you have done in your interlevel of P0 calculation? That is valuation. Sir, that is not a total value, no? Yes. If you multiply with the number of shares, you will get total value. If you not multiply with the number of shares, you will get a per share value. Both are value only. That's why sometimes they will using a word called V0. Value per share. Are you clear now? Now, you have to learn, you have to not learn, understand. Why? Because you already learned CMA interlevel. Cost of capital, capital structure, financial analysis called ratio analysis. In MTPs, they are asking a ratio analysis problem. But in a main exam, they're not asked up to now. Maybe next time we will get a problem from this ratio analysis. Okay. So it's a, I sent this ratio analysis topic to chapter 1 in SPM. 2 times is there in our board book. So for understanding of a student, I send this one ratio analysis of chapter 5 to chapter 1. I will give a clarity in chapter 1. So in this chapter, I explain only cost of capital calculation part, capital structure calculation part. Okay, done. Without late, we start with the cost of capital, guys. First, you need to learn the definition part of the cost of capital. So what is meant by cost of capital? What is meant by cost of capital? It is a minimum rate of return company need to earn to pay expectation of the investor. No one can give money for free of cost. Yes or no? No? As a company, they require 100 CR rupees. They're procuring from different people. That different people not give that 100 CR without expectation. They will expect something, either per month or per annum or a quarterly basis or hourly basis. They will expect something. As a company, what are the amount we are taken from the outsider by using in our business? We have to earn minimum that much of amount for fulfilling their expectation. That is called cost of capital. Sir, if I earn more, happy. That extra you can take as a profit share. Are you clear? If I earn less than their expectation, it's not that much of worthy. You have to pay money from your pocket. Yes or no? No? That is the basic of cost of capital. It is a minimum rate of return company need to earn to meet expectation of a investor. Done. Now, in market, we have a multiple sources for procurement of fund. But if ask anyone of a student, please give me some sources for getting money means, they told only one thing, that is called bank loan. They don't know different sources. If you want money from outsider, we have only one option, that is called bank loan. But when coming to cost of capital, saying that we have a multiple options, and that multiple options we are only figuring 5 sources. One is with help of selling of ownership. That is called equity share capital. Another one called selling of a document name called preference share. That is called preference share capital. Another source is selling of a security. That security name is debenture. You have a different terms and conditions for every security. Okay. Next, another one is mortgaging your company documents to bank. You are taking a money, that is called bank loan. You already have an existing business. You are holding money for future purposes. If you use that holding money for a business, that is called retained earnings. Are you clear? 5 sources: equity share capital, preference share capital, debenture, retained earnings, term loan or bank loan. Term loan is also known as bank loan. Hope you guys clear. Now, as a student, we need to calculate expectation of the equity shareholder, expectation of a preference shareholder, expectation of a bank, and expectation of a preference shareholder. Retained earnings is there now. That retained earnings also money, company money. The company is nothing but owner's money. The owner is nothing but equity shareholder. Again, in retained earnings point of view also, we are calculating expectation of a owner. Are you guys clear? In expectation point of view, it is a return. Company point of view, it is a cost. So we are doing all calculation in company point of view. That's why it's called cost of capital calculation. Now they are providing with shortcut names. Equity shareholder expecting equity dividend. In our company point of view, we are using a word called KE, that is called cost of equity. Preference shareholder expect something, that is called preference dividend. In company point of view, we are using a word called KP, that is called cost of preference shares. Debenture holder expect something, that is called interest. We denoted with KD, cost of a debt. In a term loan or a bank loan, they are also expecting something. That something is also be known as interest. We are denoted with KT, cost of term loan. Next, when coming to retained earnings is there now, that also be a equity shareholders money. They are expecting also equity dividend, but we are not using a word called KE. We are using a word called KR, cost of retained earnings. Very clear? At the end of the date, I can't express for equity shareholder I need to pay this much. For a preference shareholder I need to pay this much. For a debenture holder I need to pay this much. For a bank loan I need to pay this much. I can't express this kind of explanation. I will explain at the end of the year this much of cost I need to pay. I'm not talks about specification. I'm talks about total. Totally I need to pay 12%. Totally, I need to pay 10%. Totally, I need to pay 13%. Very clear. The total is known as KO, guys. The total is known as KO. Is called overall cost of capital. Overall cost of capital. It also be known as weighted average cost of capital. Weighted average cost of capital. Hope you guys clear? Very clear. Done. Why I am using a weighted average cost of capital? You will get a clarity. Why? Because I am not I am not doing a summation of individuals. For example, equity shareholder expecting 12%. Minimum return earnings also same equity shareholders money na. On the time also they're expecting same amount, 12%. Cost of preference shareholder expecting 11%. Cost of debenture holder expecting 10%. Cost of term loan expecting 10%. These are the expectations. If you sum all, please tell me the value, how much you will receive. How much is the total? 12 plus 12, 24. 10 plus 10, 20. 44. How much percentage? 50. What does it mean for 55 percentage? What does it mean for 55 percentage? Sum of the total. Okay. How you express in express to company point of view? As a CEO, you have to express that 55% to your higher authority. Now I will explain to my higher authority. We are procuring 100 CR from different sources. For that 100 CR, we have to pay 55% as an expectation at the end of the first year. Is it practically possible? Practically is possible. Why? Because if you are procuring 100 CR means as an interest portion, just an loan point of view. Forget about the sources. If I take a loan 100 CR from the bank, at the end of the first year, I need to pay 55 CR as an interest, not a principal. Practically it's not possible. Are you clear? That's why we're using a concept name called weighted average cost of capital. If you multiply with the weights, you will get a actual rates. If you sum that weighted rates, you will get a overall cost of capital. Are you clear? Before that, you have to understand how to calculate KE, how to calculate KP, how to calculate KD, how to calculate KT, how to calculate KR. After knowing that specific cost of capitals, we can easily calculate KO. Okay. Now, first I start with calculation of cost of debenture, KD. Okay. Now when coming to the definition point of view, we can use the same definition, just a change of words. It is a minimum rate of return company need to earn to meet expectation of a debenture holder instead of investor. Investor talks about total point of view, cost of capital, subject point of view. I am talking about KD na. That's a debenture holder. Now, so debenture in our law subject, we have a multiple classification of debenture. Cumulative debenture, non-cumulative debenture, redeemable debenture, irredeemable debenture. That kind of classification is there. But when coming to our cost of debt calculation, we are classifying only two types. That is called redeemable, irredeemable. Redeemable debenture, irredeemable debenture. Can anyone tell me, give answer? What is the difference between redeemable and irredeemable?
Time period.
Based on time period, we decide. Okay, done. Perpetual. Okay. That's a good one. But we have some another proper way of explanation. Any other one? What's it? Okay. Mm, mm, mm. No. So I will give a clarity. If at the time of procuring money, I'm writing a document called debenture. I'm putting a name called redeemable debenture. And that redeemable debenture, the first condition is, as a company, I'm writing the first condition to debenture holder. Irrespective of profits, I will pay your interest. The name of the document name is redeemable debenture. Irrespective of profits, I will pay interest. Second condition, you are not involved my management point of view, not attend meetings, not involved in decision making. Are you clear? You are only outside person. I take a loan from you, I will pay interest every year. That's a two condition. The third condition is the word redeemable is there now. I will pay interest every year. We are quote some certain period for 10 years or 20 years, that is called n number of years. For example, 20 years. At the end of the 20th year, I will repay your capital. For 20 years, what happened? Every year you will receive interest. At the end of the 20th year, you also get a capital or a principal amount. Okay, done. That is called a document name called redeemable debenture. Another document I issued to debenture holder. That name is irredeemable debenture. First condition is same. Irrespective of profits, I will pay interest. Second point also be same. Don't involve in my ownership point of view. You are just an outside person, take an interest. The other point is there now. It's a change. The change is I will not repay principal. I will pay only interest for perpetual life. That is the difference between redeemable and irredeemable. Hope you guys clear up. Now when coming to irredeemable, in a simple, up to n years interest at nth year principal. Guys, clear? When coming to redeemable, perpetual life or infinite life, you will receive only interest, no principal. Okay. Now, when coming to the calculation point of view, KD equals to interest 1 minus tax divided by net proceeds or market price. So I can't give a detailed clarity regarding the calculation part. It's just a EO batch, right? So hope you understand. So interest had a tax advantage. Very clear. If it's a 10% means you can't pay 10, you need not to pay 10%. And the 10% you can take a tax advantage. Of 30%, you have to pay just 7% is enough. Very clear. That's why we're doing interest 1 minus tax. Okay. Now the word NP means net proceeds. The word NP means what, guys? Net proceeds. The word MP means market price. Now, if it is a new company, we are using net proceeds. Why? Because we don't farm a market price. It's a new company. But when coming to the new existing company, our company already having a market. That's why it has a market price. It's for existing company. Now, how to calculate net proceeds, guys? How to calculate net proceeds? Issue price minus flotation cost. Issue price minus flotation cost. I have a doubt. What is the issue price? What is the issue price? Sir, issue price, it's a debenture. First, I will decide my face value. Maximum of the time. If there is no clarity, we are following assumption 100. Okay. If my company have a huge goodwill, I will sold for more than 100. If my company don't have a goodwill, I will sold less than 100. That's called issue price, sir. Yes or no? No. If I sold for 110, what is the mean for that? I sold for premium. My book value is 100 rupees, but I sold for how much? 110. I selling at premium of 10 rupees. My book value is 100 rupees. I sold for 90 discount. That is called issue price. Hope you guys clear? Now the first example, I sold for 110 now, but no one is ready to purchase that. So they're saying that 100 is a more value for your company, but you are quoting that 110. I'm not in. They're saying that I'm not interested, but we need a money. At that time, we will appoint a person name called underwriter. As per law, debenture 2.5, not exceed 2.5, equity 5%. Yes or no? No. So we will appoint underwriter. He will charge money. He will charge money. He will sold to another persons. That happen. So that the transaction purpose, he will charge commission. The commission is known as flotation cost. The commission is known as flotation cost. I sold for 110. He asked 5 rupee per debenture. Are you clear now? I sold one debenture for 110. I recovered that. Not I am. Underwriter recovered 110. But he will charge 5 rupees commission. How much I will receive? 105. That is called net proceeds. Net proceeds. How much I received by hand. Are you clear? Next, when come to the market price. So it is a purely dependent upon the existing company policies. They will decide. As per inter board book, they specifying one point. If market price information is given, take it. If net proceeds is given, take it. If both is given, follow the market price. As per board of FM material. Okay. So this is irredeemable calculation. Okay. Interest 1 minus tax divided by net proceeds or market price. Now please focus on this. KD equal to interest 1 minus tax plus RV minus NP or market price divided by n number of years whole divided by average of repayment value and net proceeds or market price. I am giving a clarity. Don't take both market price and net proceeds. You can take any one. If they provides, take that one. If both is given, go with the market price. Are you clear? If you observe the difference between this formula and this formula, not bulkiness, it is a subject knowledge is there. Simple. As per accounts, we have two concepts: revenue expenditure, capital expenditure. Revenue expenditure and capital expenditure. What's the revenue expenditure? What are the amounts were recorded in trading and P&L account? That is called revenue expenditure. What are the amount by incurring that expenditure? If you receive benefit more than 1 year, that is called capital expenditure. If you incur expenses that will generate benefit only less than 12 months, that is called revenue expenditure. Yes or no? No. Now, company point of view, irredeemable. They are paying only interest. Interest is a revenue expenditure. But when coming to the redeemable point of view, up to n number of years they will pay interest. At the end of the year they will pay capital also. That's why you have to book both revenue expenditure, capital expenditure. So this calculation for revenue expenditure, this calculation for capital expenditure. Are you clear now? Sir, here you divided only either net proceeds or market price. Now, why you are dividing here average means here only we have a single value, either net proceeds or market price. But when coming to here, we have two values, repayment value as well as net proceeds or market price. For that purpose, I using average for a decision purpose. This is the explanation of KD calculation under redeemable. Hope you guys clear? Yes or no? No? Done. So repayment also, it depends upon the question. We can repay at face value, we can repay at premium, we can repay at discount. Sir, how to calculate premium? Face value plus percentage of premium. Face value 100 always. If they specify, go with the specification. If not specify, go with the assumption 100. Hope you guys clear? Done. Next, open your material. Illustration number 1. if the rate at which company can borrow funds from the financial institution is 11% and the tax rate applicable to the company is 30%, the post-tax cost of debt would be. Guys, I will give some clarity point here, guys. A lot of students are doing a mistake on that point. They will give KD 10%. They will give a interest rate 10%, 12% in problematic portion. Until they specified, if they use the word called post-tax, that is called already interest 1 minus tax calculation. If they not provide any clarity regarding post-tax or pre-tax, assume it is a pre-tax. Don't confuse. If they specify, that time only you have to take, that is a direct calculation. If they not specify, you have to convert that pre-tax to post-tax. Why? Because in every calculation we have to use post-tax calculations. Guys, clear? Now, what are the 11% they given in the question is a pre-tax. You have to convert that into post-tax. Interest 1 minus tax divided by net proceeds or market price. There is a no net proceeds or market price in the question. That's why we are assuming face value is a net proceed. Divided by 100 into 100. Get cancel. You can use a direct calculation. It's a basic thing. It means out of 11%, you have to pay only 70% to the debenture holder. What is the 70% of 11%? So, clear? Any doubt regarding this? No. Good. Next. So there is a no redeemable calculation of individual problem. I will solve in a main problem. Next, when coming to guys, cost of preference share capital. Cost of preference share capital. Here also be same, guys. Redeemable, irredeemable. You know the meaning of redeemable and irredeemable. Same document. Here name will be changed. Redeemable preference share capital, irredeemable preference share capital. Conditions also change, guys. So there is a chance to ask a MCQ. Which one is a hybrid source of fund? Hybrid. The word hybrid means this document have some characteristics like debenture, some characteristics like equity share capital. That's why they're using a word called a hybrid security. Okay. When coming to redeemable, irredeemable, you know the meaning. Preference shareholder will receive preference dividend for n number of years. At the end of the nth year, he will also receive preference share capital back. That is called redeemable. When coming to irredeemable, preference shareholder will receive only preference dividend for infinite life or perpetual life. Hope you guys clear? Now, KP equals to preference dividend divided by net proceeds or market price. You already know how to calculate net proceeds. When coming to redeemable, guys, KP equals to preference dividend plus repayment value minus net proceeds divided by n number of years whole divided by average of repayment value and net proceeds or market price. I'm not using 100 every time. There is a pure formula is 100. Okay, done. You can observe there is a difference between KD and KP. What is the difference? Tax benefit. Not tax, but tax benefit. Interest is a fixed expenditure to the company. That's why tax department providing a tax advantage. 1 minus tax. Preference dividend is not a burden to the company. So what is the condition we are imposing in a security? After settlement of money to debenture holder, we get a money name called net profit. That is called owner's profit. As a owner, we are not sharing that net profit. I will pay first to you. Preference payment. After settling to you, we will share the remaining profits. That kind of condition we are imposing in preference share capital. Are you guys clear? Done. So that's why preference dividend don't have a tax advantage. Only interest have a tax advantage. That's why I'm not using preference dividend 1 minus tax. That's interest have a tax advantage. That's why I regarded interest 1 minus tax. Clear? Done. The main and important thing is came here. Cost of equity. It is denoted with KE, guys. It is denoted with KE. Now, the calculation of KE is difficult comparing to KP and KD. MCQ. So why it's difficult comparing to KP KD means the first thing is uncertainty in profits, guys. Uncertainty in profits. We can't say this much every year we will receive this much of profits. It will be increase, it will be decrease. Uncertainty in profits. Interest is a numerator. Preference dividend is a numerator. Benefit is a numerator, na? Or cost is a numerator. That we can fix. But this profits we can't fix. First reason. Next one. No base rate. No base rate. What is the mean for no base rate? At the time of debenture framing, we will decide one rate. 10% debenture, 12% debenture, 14% debenture. You can observe in balance sheet any debenture word, there is a prefix. Rate of the prefix. We can decide. That's the base we are using. When coming to preference share capital, also same. 10% preference share capital, 12% preference share capital. But anyone observed that equity share capital prefix? 5% equity share capital, 10% equity share capital. No. Because of no base rate, we can't calculate easily. The third point, guys, growth. The third point is growth. Growth, I will share to only owners, not to outsiders. I am not give that benefit to whom? Equity share, I am not give that benefit to debenture holder, bankers, preference shareholder. The growth aspect I will give only to owners. The growth also we can't decide. It also be uncertain. Because of the three reasons, KE is difficult. So one time they ask MCQ. Okay. Now, even though difficult, as a student, we have to calculate now. Yes or no? They will say using your, it is difficult to calculate, not that much of easy. They can say, but we have to figure out the answers. Now that the purpose they provided earning model, dividend model, CAPM, realized yield. For only KE calculation, you have four methods. Now, maximum of the, not maximum of the time, always they are preferring model name called dividend model. In this dividend model also, you have a two classification: without growth, with growth. Without growth and with growth. When coming to without growth, KE equals to expected dividend. Expected dividend is there is a clue words: expected dividend, next year dividend, estimated dividend. You have to figure out that only. Expected dividend divided by P naught. There is a no growth concept. When coming to with growth concept, equity expectation equals to expected dividend or next year dividend or estimated dividend divided by P naught plus growth. The P naught is nothing but current market price. Guys, clear? Now, when coming to earning model, same logic: without growth, with growth. Without growth, KE equals to, instead of dividend, we are using earnings. EPS, expected EPS divided by P naught plus growth. Okay. So how I calculate dividends, DPS? EPS into payout ratio. EPS is 10 rupees. They pay dividend of 40%. How much is the DPS? 4 rupees. 10 into 40%. Guys, clear? The basic calculations are involved, guys. Just if you keep observing that detailingly, you get answers. Next, you know CAPM. What's the full form for CAPM? Capital Asset Pricing Model. Capital Asset Pricing Model. When coming to Capital Asset Pricing Model, KE equals to RF plus beta into RM minus RF. RR plus beta into RM minus RF. Okay. Now the word RF represent, you know that, risk-free rate of return. If you invest in government securities, they are comparing to private sector riskless. If you invest instead of private sector, if you invest in government sector, that is called risk-free returns. Guys, clear? We have two options, guys. One is SBI bank investment, another one is Axis bank investment. As an investor, which we as a person, you are not taking a risk in life. Now, please pick one bank for investment. What will you prefer? Private bank or public bank? Public bank only. Why? Because both are risky only. But comparing to Axis Bank, SBI risk is less. The same thing, you have an option in government security bonds. Another one is bank investment. Which one is a better one for risk-free person? Government security. Why? Because bank will they have, if they do a fraud transaction, they will close. But in the government point of view, 5 years another person will come. There is no risk, na? Yes or no? Done. When coming to RF, risk-free rate of return, beta. So this is called risk of a security. Risk of a security. And RM is return on market, like total average return of SEBI, NSC, not SEBI, NSC, BSC. Are you clear? The market return is nothing but you have a multiple securities. TCS shares is there, and Wipro shares is there, Tata shares is there, as well as Reliance Industries shares is there. The combine of all shares is known as portfolio, but average of that 4 company shares is known as a return on market portfolio. Are you clear? They will specify either NSC return or BSC return. Next, the point is very, very important point. Sometimes they will directly give RM minus RF. RM minus RF. That is called risk premium. If the word they use as risk premium, so student out of overlook, they feel that it is RM. It is not RM. It is a difference of RM and RF. You can take direct that value. Hope you guys clear up. Don't do mistake that again. Now, the expectation of an investor depends upon the risk. If their risk increases, they're expecting more. If their risk decreases, they will reduce their expectation. Hope you guys clear up. So, expectation, that is K is purely dependent upon the beta. So, realized yield not required here. Just these methods are important. And this also, this one is a highly important. And next, this one. So next, cost of retained earnings, guys. So this basic problems I am not take from FM, guys. These problems already in your board book only. These are your board book content and board book problems only. Don't feel why I am learning again FM. Okay. So these are fundamentals they provided in your board book. There is a chance for getting 7 marks for 5A question. So generally, KR is nothing but KE, guys. KR is nothing but KE. So why? Because 2 funds are bonus funds only. Retained earnings are bonus funds. Equity share capital also a bonus fund. That's why they will expect same. If question specifies flotation cost and personal tax, corporate tax is different, personal tax is different. Corporate tax means what are the you have to pay amount on your company earning profits. Personal tax is not related to company profits. It related to dividend point of view. Individual taxation. Now, if flotation cost is given, guys, KE not equals to KR, guys. If flotation cost is given, KE not equals to KR. How, sir? See, if there is a flotation cost, KE equals to D1 divided by P0 minus flotation cost plus growth. KR equals to D1 divided by P0 plus growth. Understand the concept. When we are paying flotation cost, when we are paying a flotation cost at the time of sale of securities. In retained earnings point of view, what you are selling? In retained earnings point of view, what you are selling in the market? Nothing is selling. You are just taking money from bank. Yes or no? No. At the time of using retained earnings, you need not to pay what? Flotation cost. But at the time of issue of shares, you have to pay flotation cost. That's why I deducted flotation cost here. I am not considered flotation cost here. Why am I deducting means KE calculation, issue of shares. Why I am not deducting means retained earnings, there is no flotation cost. Clear? That's why here you will get one answer, here you will get one answer. That is a mean called not equal. Clear? Next, if they specify personal tax, guys, KR equals to, what are the calculation you already done for KE? That is nothing but KR equal to KE, na? But they specified personal tax, you have to deduct that 1 minus personal tax. 1 minus personal tax. So these are the differences we have. If there is a flotation cost, if there is a personal tax. Unless there is a no flotation cost and personal tax, KE is nothing but KR. Clear? Next, the last one, KT, interest 1 minus tax. Interest 1 minus tax. Sir, why you are not divided with the NPR market price? These are the basic stuff we student are missing, sir. Generally, KD calculation you use interest 1 minus tax divided by net proceeds or market price. But when coming to KD calculation, why you are not divided with the NPR market price? Sir, in a term loan or a bank loan, I am not selling anything, sir. I am mortgaging my company document to the bank. That's why I don't have a net proceed, I don't have a market price. When coming to debenture, sir, I am selling security name called debenture. That's why I have a net proceed, that's why and also have a market price. That is the differences. Okay. Now, we can easily calculate market value of equity share capital. We can easily calculate market value of preference shares. We can easily calculate market value of a debenture. But we can't calculate market value of retained earnings. We can't calculate market value of term loan. Why? Because we are not selling security in these two cases. Yes or no? No. So if you have a number of security, if you multiply with the MPS, you will get a market value. But when coming to retained earnings and term loan, there is a no MPS. Not MPS, there is a no securities. We can't multiply. Yes or no? But when coming to KO calculation, they are expecting two kind of calculation. KO as per book values, KO as per market values. KO as well as per book values, KO as per market values. Book value is nothing but what are the amounts you already recorded in your balance sheet, that is called book value. Are you clear? But when coming to the market value calculation, how to calculate market values? Number of securities into market price. Equity share capital we have, number of securities we have, MPS we have. Preference share also, number of securities there, MPS is there. Debentures also, number of debentures is there, MPS is there. Yes or no? No? We can easily figure out the market values. When coming to the retained earnings, how you calculate market values? It include already in market price. For the market price, you are multiplying with the number of shares. That MPS includes equity share capital value as well as retained earnings value. When coming to this term loan is there, how to calculate market value of a term loan? There is a no market value. Assuming book value is nothing but market value. Guys, clear? Done. Now, when coming to KO calculation, guys, sources, book value or market value, what they're asking, you can write that. Amounts, book value amounts or market value amounts. Next, weights, guys, weights. Next, specific cost of capital. What you learned, KE calculation, KP, KD, KR, KD calculation, that you have to figure out here also. Specific cost of capital. Product, guys. The product is nothing but weight into specific cost of capital. Okay. Now we have a 5 sources. There is a not mandatory for all times. They will expect 5 sources. Sometimes they will ask 4. Sometimes they will ask 3. Depends upon the question. So equity share capital, retained earnings, preference share capital, debenture, term loan. So you have to record what are the values they given, either book values or market values. Now total amount is known as, guys, capital employed. Total amount is known as capital employed. Sir, how I get equity weight? Equity weight of equity equals to amount of equity share capital divided by capital employed. Specific capital divided by total. You will get a proportion. So for example, if I take I procure 1 rupee, out of 1 rupee, what is the equity portion? What is the return earning portion? What is the preference share capital portion? What is the debenture portion? What is the term loan portion? Calculation of the proportion is known as weights. How I calculate? Individual capital divided by total. Are you clear? Done. So specific cost of capital I already explained in above. So you will get already weights, you will get already specific cost of capital. If you multiply individually, you will get a products. Sum of all products is known as weighted average cost of capital. Weighted average cost of capital. It also be known as KO. Okay, done. Come to illustration number 2, guys. Illustration number 2. So I think it is a KE calculation based on CAPM. So what's the formula? RF plus beta into RM minus RF. So please insert the values. Instead of direct values, go with the rates. Percentage is different, rate is different. So rate is 0.075. Very clear? Now follow the unique pattern. So all people are using percentages. In this chapter, lot of marks we are losing only because of calculation mistakes. They are taking 7.5%, but they are in calculator they are using 0.075. Are you clear? So just to follow the pattern. So I'm taking a rate 0. In any percentage calculation, you have to follow rate. Why? Because if you are using in a single formula, you are using rupee value, and that rupee value point of view, you don't use a percentage. Go with the rate. Are you clear? So 0.075 plus what's the beta? 1.21. What is the RM? Market return. I already told you BSc, NSC. How much? 15%. 0.15. RF 0.075. So first you have to solve this 0.15 minus 0.075. You will get same 0.075 into 1.2 plus 0.075. You will get a rate answer only. If you want percentage, go with the into 100. So what is the answer? 0.165. So ORR you can also write like this, 16.5%. Next, this is MCQ, beta calculation, covariance of market security divided by variance of market security. So, but in this question, they provided a standard deviation. What you required? Variance. So, how to calculate variance? Standard deviation, square root of variance, square of variance. I am asking that how to calculate variance. Square of standard deviation. So standard deviation equal to square root of variance. If I want variance, standard deviation square. Are you guys clear? So don't lose that hope, lose that point. Why? Because You know we know the formula. What is the formula? Variance, market variance. But for confusion purpose, they have provided a standard deviation. Guys, clear? Now, what is the covariance they given? 0.05 divided by standard deviation square, 0.25 square. How much? 0.0625. 0.25 square. 0.0625. What is the answer? 0.05 divided by 0.0625. What? 0.8. Guys, clear? Next, come to illustration number 4. Deepak D. Sir, can you please keep this on YouTube? Yes. Only up to afternoon session only, guys. Suppose Alpha Limited has a capital structure composed of the following: debt 30 million, equity 45 million. If before tax cost of debt is 11%, pre-tax or post-tax? 11% pre-tax. So when calculation, what kind of KD we have to use? Post-tax. The required rate of return on equity 16.5%. There is nothing but KE. And the marginal tax rate is 30%. Corporate tax rate is also been known as marginal tax rate. What is the Alpha Limited's weighted average cost of capital? They provided only 2 sources. So when coming to KO, weight of equity into cost of equity plus weight of debt into cost of debt. Very clear? This kind of problems, they are not expert for 7 marks. That's why this kind of problems they are expert for 2 mark MCQ. You can solve directly. Now I already told how to calculate weight of equity. How to calculate weight of equity? Amount of equity share capital divided by capital employed. So sum of capitals is known as capital employed. So what is the equity value? 45 million. What is the total? 45 plus 30, 70. They given in the KE 0.75. What is the KE? 0.165. I already told. I am taking a rupees for weights. That's why I am taking instead of percentage rate. Plus weight of debt, guys, 30 divided by 75 plus not 11%. 11 into 70%. Why 11 into 70%? 1 minus tax is there, na? So 0.11 into 0.7. Now please tell me the weight of equity. 45 divided by 75. What? 0.6. It means if you are procuring 1 rupee, and that 1 rupee 60 paisa is equity, 40 paisa is a debt. So see 0.6 into, not plus, guys, into this only plus, this also be into 0.165 plus 0.4 into 0.077 KD. What is the answer? 0.6 into 0.165 M plus 0.4 into 0.077 M plus GT. Go with the shortcuts. So 0.6 into 0.165 M plus 0.4 into 0.077 M plus GT or MRC. Some calculators give GT, some calculators give MRC. 0.98 or 12.98%. Any doubt regarding this? Sure. Done. Illustration number 5, guys. Illustration number 5. Mahavir Limited has the following capital structure. The word capital structure represents book values, guys. Generally, it's a book values. They specifies if it is a market value, assume it is a market value. In a FM, they are not specifying this word market values. They will use the sentence Mahavir Limited has the following capital structure. If the words are given without a market value, that are the book values. But here, what they specify, what are the values I am provided is a market values. Okay, done. So equity share capital 80,000 into face value 10 rupees, 8 lakhs is a book value. But how much they recorded here? 100 lakhs. 8 lakhs is a book value, 100 lakhs is a market value. 15% preference share capital, 6,000 shares, 100 rupees each. 6 lakhs, 6 lakhs is the book value, but what they recorded? 6,21,000. It means what? Market value. Debentures, guys. Face value 1,000. Here you will get some amount called 9,70,000. If I know the debenture, I calculate with face value. If that amount and given amount is different, I will decide this is the face value, this is the market value. But here one is missing, that is called number of debentures. Number of debenture. So now you have to assume some number of debentures is there. You can take whatever assumption you want. There is no number of debentures information. If it knows only, you can solve the problem. Why? Because I will give a clarity at the time of calculation. So here you don't know the number of debenture, you can't solve the problem. At the time of KD, you understand why number of debentures assumption is required. But here I am taking assumption 1,000. Why? Because the 1,000 only will give a nearest values of this. If you assume 100, right? If you assume 10, right? But the accuracy for the calculation is 1,000. Are you clear? So for assumption, number of debentures equals to how much, guys? 1,000. Now 1,000 into 1,000, 10 lakhs. But how much they are? 9,70,000. Market value only, but less than the book value. Are you clear? Done. 16% term loan, 8 lakhs. Book value as well as market value both are same. So there is no specification of rate and earnings. We are not focusing on that. Now see, the dividend per share expected for next year. Can I use the word D1? What is the word of D1? Expected or next year or estimated? The word expected. Expected to grow at the rate of 12%. Can I use the word growth rate? I can simply say it is a with growth concept dividend model. Are you clear? In every problem in additional information, they will give this kind of information. You have to decide which method it is. Because of dividend information, I can decide it is a dividend model. On the dividend model also, with growth, without growth is there. If they are specifying the growth rate, it is a with growth model. If not specifying the growth calculation, without growth calculation. Next, preference shares are redeemable after. Can I use the word redeemable preference share capital? The word itself is saying that redeemable. Amount of premium 5%. Generally face value 100, but we are not paying 100 rupees, we are paying 105. And debentures are redeemable. It also be a redeemable debenture. Redeemed at face value. What is the face value? Not 100, they specifying 1,000. Are you clear? If they are not specified, go with the assumption 100. Next, the applicable tax rate of the company is 40%. You are required to calculate weighted average cost of capital using market value as a weights. Now see, first you have to figure out KE, guys. How to calculate KE? Decided na based on information. D1 divided by P0 plus growth. D1 directly I have 3.5 divided by P0 I don't know, plus growth I know 0.12. I don't know P0 as well as I don't know the net proceeds information, but I have a clue. Market value divided by number of shares. Market value divided by number of shares. I will get what? MPS. Now what is the market value, guys? 100 lakhs. 100 lakhs divided by face value. Sorry, number of shares. 0.2. 0.08 or 0.8? 0.8. Answer? Rupees 125. Now I got a K. How much? 3.5 divided by 125 plus 0.12. 0.148 or 14.8%. Next KP calculation, guys. Redeemable or irredeemable? You have to decide first. Redeemable. Then write down the formula directly. Preference dividend plus repayment value minus net proceeds or not net proceeds, market price. Hope you guys you understand. Why? Because there is no net proceeds information. We have only market price. That to be not direct, indirect. Divided by number of years, whole divided by repayment value and market price average. Now, how to calculate preference dividend? Face value into percentage, guys. What's the face value? 100 into 15%. That is nothing but 15 rupees. Plus, so people are taking 0.15. 0.15. No, amount we have to consider. If you take 0.15 plus rupee values, answer is wrong. Very clear? If you are using a rupee value means you have to consider rate. So 15% is nothing but 15 rupees. Now what is the repayment value? Repayment at premium 105. Okay. Minus market price. Market value of preference share capital 8 lakhs. No, sorry, not 8 lakhs. 6,21,000 divided by preference shares. 6,000. 103. 3.5 divided by number of years. 5 years. Whole divided by average 105. 103. First solve this one. 105 minus 103.5 divided by 5. 15 plus 0.8. 0.03, just 0.3. Okay. Divided by average, please. 104.25. Answer 0.1468 or 14.68%. Clear? Next, KD calculation. What? Number of? No issue. There is no issue. That decimal value not decide your entire solution. Very clear. That kind of assumptions you can write. If you have a doubt, go with the assumption. I am round offing that 1035 into 104. Note that note point. Come to KD calculation, guys. What is the interest? Face value into percentage. How much? 1000 into 140, 140. 1 minus tax. What is the tax rate? 1 minus 0.4. Repayment rate? No specification or specification. That is a preference shares. They're specifying face value. If there is no specification, on the time also face value only. What is the face value? 1000 minus net proceeds or market price? Market price. How we get a market price of a debenture? Market value of a debt divided by number of debentures. Where is the number of debentures? So we have to assume. Yes or no? No. If you don't take an assumption, here you will stuck. Guys, clear? Now we take an assumption 9 lakh. Market value of debt, please. Market value for debt 9 lakh 70. 9 lakh 70,000. We are taking assumption number of debentures is 1000. Answer 970. So why I am taking assumption means for this purpose. You can see observe near values 1000 and 970. So if you take assumption one debenture, so what is the value? 9 lakh 70,000 only. If you assume 10 debentures, clear, done. Divided by number of years of repayment, 10 years. Whole divided by average. Please solve and tell me the answer. Zero point 0.088. Okay. Now KO calculation. Sources, market values, weights, specific cost of capital, product. So equity, preference share capital, debenture, term loan. So we go with the specification of rates. Preference share 15%. What about the debenture? 14%. What about the term loan? 16%. I think we are not calculated KT. So simple, KT equals to 0.16, 1 minus tax. Answer please. 40% only, na tax rate. Answer 0.096 or 9.6%. Now please tell me the market value of equity. 100 lakhs. What about the preference share capital? 6.21 lakhs. 9.7 lakhs. 8 lakhs. Please total it. 123.91 lakhs. This is called capital employed. Now please find out the weights, guys. 100 divided by 123.91. 0.807. 6.21 divided by 123.91. 0.05. 9.7 divided by 123.91. 0.078. 8 divided by 123.91. 0.065. So if you want a clarity, if you sum all, you will get a 1 rupee. Are you clear? You can take a percentage also. It will equate to 100%. Guys, clear? Done. Specific cost of capital. You already calculated, na? KE please. 0.148. KP 147. KD. Okay. KD 0.088. What about the KD? 0.096. Now please find out the product. (0.807 into 0.148). (0.1194). 0.05 into 0.147. 0.0073. Okay. You can fix, you can go with the either 3 decimals or 2 decimals or 4 decimals. For you get a unique pattern. Okay. No, nothing is wrong is there. You can go with the uniformity. Next. 0.078 into 0.088. 0.0061 or 262. 8 round off. 0.00618 na. I round off that 8 into 2 here. Next. 0.065 into 0.096. 0.0062. 0.98 or 13.98%. You will get some difference between book answer and this answer by because of decimal values. Are you guys clear? If you get an answer 30%, that is wrong. If you get a 13.5, 13.6, that is right. Are you clear? Now, I will give you some subject clarity. Please sum specific cost of capital. Please sum specific cost of capital. Zero point 0.479. Can I take it is a round off with 50%? Now observe. If you sum only individual specific cost of capital, you have to pay 50% at the end of the first year as a interest. If you go with the product summation, you have to pay 13.98% is a expectation of the investor. Now, which one is the right one? 50% or 13.98%? That is called KO calculation or weighted average cost of capital calculation. Here we are not adding individually, we are using weighted individuals. Guys, clear? Done. Yeah. Come to illustration number 6 is a basic problem. Just understand the question, you will get a clarity. Let's assume that shareholders of Miss Alka holds the shares of A Limited for how much period? So this is called infinity period calculation part. Okay. Now, A Limited is a matured company giving a constant dividend of rupees 3 per share. What's the mean for constant dividend? Every year. No. There is no growth. Constant, na? 10 years back I receiving 3 rupees. 5 years back I receiving 3 rupees. 2 years back I receiving 3 rupees. This year also receiving 3 rupees. That is called constant. If you have a growth na, 10 years back 3 rupees, now it is 4 rupees. 3 years back it's a 3 rupees, now it is a 5.6 rupees. That is called growth concept. Guys, clear? Now here it is a without growth concept. There is a no growth aspect. Okay, done. Miss Alka expect 12% return from her investment in A Limited. Expectation is nothing but KE. Why? Because they are talking about dividend. Yes or no? Na? Done. The value of the value of A Limited for Miss Alka would be given by the present value of a dividend received forever. Now see. You have to understand the concept. Noun period calculation. Infinite life calculation. Guys, you got the meaning of these two words. I have a 4 years information. I am using a concept called noun period calculation. I have information not for specific period. That is called infinite life calculation. Now see, in this infinite life calculation, we are following a two concepts: without growth, with growth, without growth and with growth. Now when coming to without growth, V naught, you can also use the word P naught. D1 divided by P or D1 divided by K. Instead of K, they are using a word called R. R is nothing but required rate of return. That is nothing but expectation. That is nothing but K. Just a word, a reference name is changed. Okay, now in final level, instead of K, they are using R. Guys, clear? When coming to with growth concept, V naught or P naught equals to D1 divided by R minus G. R minus G. I already explained that intro. We already done a valuation in our KE calculation with the help of KE calculation. That reflection it is. So generally, KE equals to D1 divided by P naught plus G. If I want P naught, I shuffle the formula. I will send this G into this side. What happened? KE minus G equals to D1 divided by P naught. I want P naught, that's why I will shuffle this 2. Now what happened? P naught equals to D1 divided by KE minus G. Instead of KE, what they're using? R. Instead of P naught, what they're using? V naught. Guys, clear? This kind of calculation we are using for which infinite life point of view. Now, without growth, with growth, without growth and with growth. D1 3 rupees, D2 3 rupees, D3 also 3 rupees. This is the information I have. First year how much I receive? 3 rupees. Second year 3 rupees. Third year 3 rupees. But they're asking a answer V naught. What is the word of V naught? No. Current value per share. The specification is important. The word not represent current period, today value. Are you clear? But D1 is a future value. D2 is a future value. D3 is a future value. You have to bring that future economic benefit to present value. How it possible? If you multiply with the present value factor, first year, given rate. If you multiply with present value factor, second year, R percentage. If you multiply with present value factor, third year, R, you will get present values. That is the way to value per share or current market present value per share calculation. When if it is a noun period calculation. Guys, clear? When coming to this is there now. If you are doing at present, V naught and present both are same. If you are doing at middle of the, if you are doing this calculation at 4th year, you have to bring this values also from 4th year to present value. Guys, clear? Now see, without growth, guys, here you need to focus more. They will give D naught, guys. D naught is 3 rupees. Growth equals to 10%. D naught equals to 3 rupees. Growth equals to 10%. What's the mean for D naught? Current year dividend. But what I want? Next year dividend D1. Yes or no? Na? Now D1 equals to D naught 1 plus growth. Now please find out the D1. 3, 1.1, 3.3. How you get a D2, guys? Yeah, D1, 1 plus growth. That is nothing but 3.3 into 1 plus 0.1. That is nothing but 1.1. Every year 10%. Na? Answer? 3.63. How you get D3, guys? D2, 1 plus growth. For a D3, D2 is a current year. If you add that 365 days growth, you will get next year. Now 3.63 into 10% increment 1.1. 3.9993. So there is an alternative calculation, guys. What is the alternative calculation means? D3 equals to D0 into 1 plus growth power 3. Just an alternative calculation, don't confuse. In the books, sometimes they will give that calculation, sometimes they will we are using that calculation. Both are same answer. What does it mean for a cube? For 0 period dividend, we are adding 3 years growth. That's a cube mean. Okay, there is nothing is new. There is just a calculation pattern. Okay, done. So that is the difference between with growth and without growth. Are you got a clarity? 3 here, not 3. Every year 10% is increment. But you required V0. What does it mean for V0? Current value per share or current market price per share. This 3.3 is a current value or future value. That's why you have to bring with the help of present value factor. This also be a future value you have to bring with the help of present value factor. This also be a future value you have to bring with the help of present value factor. Guys, clear? Done. Now, come to our material. Now, what kind of problem it is? Noun period or infinity period? Infinity period. With growth or without growth? Middle of the period calculation or at the present only? Present only. I don't have a number of years information. That's why it's a current period, today only. That's why you can use directly V0 equals to D1 divided by P0, K or required rate of return. What is the D1? 3. Required rate of return? 0.12. Answer? Rupees 25. So this is called present value. Next, when coming to extension of that sixth problem, extending our previous example, Alka hopes that A Limited will give a dividend of rupees 3 per share next year. Next year means D1. And they are expected to grow at constant rate of 6%. What does it mean for 6%? Growth rate. Forever. The value of A Limited today V0 for Miss Alka would be given as follows. So it is an infinite calculation as well as growth with growth calculation. It is not between the years. Between the years, not only please understand. Between the years means I have a n number of years information. After that, I don't have a n number of information. I have a just infinite life information. That is called between of the years. If there is a no between of the years, it is current calculation only. Now see, V0 equals to D1 divided by R minus G. What's the D1? 3. R. In this problem, there is no R, but it is an extension, na? 6. 0.12. Growth rate is given. 0.06. Answer? Rupees 50. Now, come to illustration number 9. Come to illustration number 9. Python Limited currently pays a dividend of rupees currently D0 or D1? D0. What you required? D1. You know how to convert D0 into D1. Don't miss that logic. Okay. A valuer forecast means, the word forecast means noun period. The word forecast means we know the period. Forecast growth 15% for next. What is the noun period? 3 years. Every year there is a growth 15%. Guys, clear? Done. Followed by 4% growth in perpetuity. What does it mean for that? From 4th year onwards, I don't know the full information. I have a perpetual information. The growth value is 4%. Okay, done. Thereafter, the required return is can I use the word R? Okay. Calculate the current value per share. Now, which model it is? Noun period model or with infinite period model? No, combination. 3 years is noun period. 4th year onwards, infinite period calculation. Guys, clear? That's I told between the years. This is between the years. Clear? Now, here's just a presentation purpose. If they ask you for 7 marks this question, you have to present neatly. Here's expected dividend. Next, present value factor at the rate of 15%. The only rate we have 15%. Generally, for present value factor calculation, we are using cost of capital. So in this calculation, they are not using a KO. That's why we are considering KE as a cost of capital value. Simple. One MCQ is there in a final level only. Company follow 100% equity. KO is nothing but K. 2 marks MCQ. I think December 23. Guys, clear? It means there is no specification of the date. It means we are assuming that the company follow 100% equity. On that time, K is nothing but KO. Now, you will get a present value of a dividend. Year 1, how much is the dividend? No. Just first understand D naught. D naught is 2. But how first year I don't want a D naught, I want a D1. How we get a D1? D1 equals to D naught 1 plus growth. Now D naught is 2 rupees into 1 plus growth. What is the 1 plus growth? 1.15 only na. Now what is the expected dividend? 2.3. When coming to the second year, D2 equals to D1 into 1 plus growth. 2.64. Third year, D3. How you get a D3? D2 into 1 plus growth. 3.04. Clear? Now, these are the forecasted period information. Forecasted means non-period information. So this is a 1 year feature. You have to bring that to present value. How it possible? Take your calculator. 1 divided by 1.15 plus equals to answer 0.086 8695 plus again equals to 0.7561 plus again equals to 65. Now please tell me the present value of dividend. 2.3 into 0.86795. 1.99. Second year present value. 2.64 into 0.7561. 1.99. Okay. 3.04 into 0.6575. 1 point. Total. How? Answer. Two 2.04, 2.07, 2.11. These are the present values. Where we done a mistake? These values are right. 2.3, 2.65, 3.04. These values are right. Now present values, check the present values. Sorry. So growth is a 15%. Sorry guys. So rectify the values guys. Not 15%. Required return is a 13% guys. So we are wrongly taken instead of required return growth rate. Now please tell me the values. 0.45, okay. 78, okay. Okay, done. Double eight. Now tell me the present value of a dividend. 2.04, okay. Two point zero. Next 2.11. 3.04 into 0.6931. Okay, guys, up to here we just calculated forecasted calculation, but there is a calculation part called infinity life calculation. First we have to do value, find out the value. Okay, for find out in the value only you have to do a calculation part. These are the pattern followed in chapter 6 also. For entire discounting cash flow method we are following that kind of calculation. Now first you have to figure out are you agree for this? Third year to infinity or fourth year to infinity? Third year to infinity or fourth year to infinity? Okay, done. What's the mean for this first year? Beginning of the first year or ending of the first year? Beginning of the first year or ending of the first year? No. Unless they specify year means we have to follow end of the year. That's why only you are bringing the 2.3 into present value. If you are at the day one means why you are using present value factor? You are doing calculation at day one, but the value at end of the 365th day. You are at the day one, the secondary value at the end of the 265 days away. You are at the day one, the third year value at the end of the 365 days away. Hope we get clear? Now it means fourth year beginning, third year ending. Infinity calculation, fourth year beginning to third year ending. You are doing a calculation at fourth year beginning at third year ending. First we have to figure out the value. So how to figure out the value, guys? D1 divided by R minus G. R minus G. Now D1, okay. Which D1 we have to consider? We are calculating third year now. That's why you have to consider this one. Not D1. Here you have to follow D3. Okay. D3. It is a D3. Here also D3. But I want future value. How it possible? With help of 1 plus growth. With help of 1 plus growth. Why? Because this 3.04 is there now. That is the end of the third year. But I am calculating for future. Now see the another logic here. D3 3.04 1 plus growth, please. That growth you have to consider. Long term growth 0.04 divided by R 0.13 minus growth 0.04. How much? .04 into 1.04 divided by 0.08. 0.09. 35 point. That is called value. It is not a present value. That is called just value. So what is the value, guys? 35 point. What does it mean for 35.13? Third year ending to infinity life. There is an estimation of dividend you will receive is 35.13. Not for number of years, it's for infinity life years. Are you clear? Now when you are doing this calculation, today or future? Future. Which future? Fourth year beginning. That is nothing but So there is a no beginning present value factor. We have only ending present value factor. That's why you have to consider what 0.6931 only. I got the logic. So I am not doing this calculation at the end of the fourth year. I am doing this calculation at the end of the third year, beginning of the fourth year. That's why I used a third year present value factor. Please answer. 24.35. Now please sum all. 3.0, 2.04, 2.07, 2.11, 24.35. 30.57 rupees. This is a way to find out value per share by using forecasted period as well as effect period. Any doubt regarding this? Sure. So here you have to keep more time. You have to invest that. First you have to figure out value per share. Very clear? On that above calculation we are calculating only dividend. But at the third year to infinity, we are not finding out in dividend, we are finding out in value. Are you okay? That value we are calculating at the end of the third year, that's why I have to bring that third year value to present value. And sometimes they will give a growth rate. A short-term growth rate is 1, long-term growth rate is 1. For a long-term calculation, that is nothing but infinity period. You have to use a long-term growth rate. For a short-term, you have to focus on short-term growth rate. Okay? For a confuse purpose, they will play some trick. Required rate is there, not 13%. They will use long-term required rate of return 14%. For a short-term present value purpose, we are using 13%. So student will confuse. For a long-term calculation is there, now this 35.13. For that they will use 14%. Why? Because long-term cost of capital. No, where you are doing third year only, na? That's why you have to consider 13% only. Okay, fourth year onwards, but I am doing calculation at a third year ending. Not required. Just for confuse purpose they will give. Okay. Come to illustration number 8. In December 23, they asked 7 marks. I already told now, basic problem. Case 1 is basic only. When come to the case 2. So everyone feel that if I solve case 1, I will get half of the marks. No, for case 1, 2 marks. For case 2, 5 marks. As per suggested answer. The entire stuff in case 2. If you understand about theoretical discussion, then you can easily crack. Even though there is some advanced point is there. The following information of Achal Limited are given. Current dividend rupees D0. Discount rate 10.5%. That is nothing but cost of capital. You can also use the word called R, required rate of return. Growth rate G. Based on the above information of Achal Limited, you are required to calculate present value of a stock of Achal Limited. I understand that is a with growth, infinite period growth calculation. Why? Because there is a no forecasted. Simply I can figure out V0 equals to D1 divided by R minus G. So they given D0. I have to convert that. How I convert 2.5 into 1.02. 1 plus growth only, na? Divided by R 0.105 minus growth 0.02. Please tell me the answer. What, sir? 2.5 into 1.02. How much? What now? 2.55. divided by 0.105 minus 0.02. 0.085. Answer? Rupees. Case 1 done. Sir, how I decide it is a infinite period with growth model? Why? Because there is a no forecasted period calculation. There is a growth value. There is expected dividend. There is a market price. Yes or no? No? There is no growth rate and a required rate of return. I can easily find out market price. Now case 2. Come to case 2. Understand first. Assess stock of HR Limited whether it is overvalued if the stock price is rupees 35. Return on equity is 9% and EPS is 2.25. Support your answer with complete workings. Just a single word they are using. Just I will give a clue. Based on clue, you can do whatever you want. I want complete workings. Meaning of that complete workings, that much. Guys, clear? Now, you know how to calculate overpriced and underpriced calculation. What are the price they given, that is called actual. What are the amount you are calculated, that is expected. Very clear? The expected means you are ready to buy with your expected price. But in actual, there is a reality. If your expected price is 30 rupees, what are the calculation you've done? That is called expected price. That is 30 rupees. What does it mean for 30? I can buy that share up to 30 rupees. That is a worth to me. But what is the actual? Overvalued or undervalued? That's it. I calculated P naught expected 25 rupees. Not 25. 40 rupees. 40 rupees. What does it mean for 40 rupees? That security worth you can buy up to 40 rupees. That is a benefit. But what is the actual? Overvalued or undervalued? It is a more benefit, na? Buy more. Are you clear? Okay. Where is the 40? Where is the 30? That you have to calculate. Okay, done. See. You know the PE ratio? Price earning ratio. How to calculate means MPS divided by EPS. If you know the PE ratio, if you know the EPS, you can easily figure out MPS. That is also one of the expectation calculation part of MPS. Yes or no? No. If you know the what? PE ratio, if you know the EPS, you can easily figure out MPS. How? MPS equals to PE ratio into EPS. EPS is there 2.25. If you know the PE ratio, you can easily figure out MPS. Okay. Now, PE ratio equals to MPS divided by EPS. It is per share point of view. It also have a total point of view calculation. Market value of equity divided by equity earnings. This also will give same answer. Total point of view per unit point of view. For understanding purpose, I am using market value of equity divided by EA/ESH. Market value of equity divided by EA/ESH. EA/ESH is nothing but earnings available for equity shareholder. That is nothing but equity earnings, right? But there is no MPS, there is no EPS calculation part. But they provided return on equity, guys. Return on equity. What's the formula for return on equity? EA/ESH divided by equity. EA/ESH divided by equity. Can I write like this? EA/ESH divided by market value of equity. Okay. Now see. P ratio equals to. Can I write like this? 1 divided by return on equity. 1 divided by return on equity. Now 1 divided by, what's the formula for return on equity? EA ESH divided by market value of equity. Now what happened here? 1 into EA ESH divided by market value of equity. Sorry. Market value of equity reverse now divided by EA ESH. Now what is the formula of PE ratio? MPS divided by EPS. Total point of view. Market value of equity divided by EA ESH. You can observe this. 1 divided by return on equity. That is nothing but EA ESH divided by market value of equity. If you shuffle the formula, what happened? Market value of equity divided by EA ESH. It means you can calculate PE ratio with help of return on equity also. How, sir? 1 divided by return on equity is nothing but PE ratio. Now tell me the PE ratio. Any confusing, sir? No, no. 1 divided by? What is the answer? 0.1. No, I think. Go with the rate. 1 divided by? 11.11. PE ratio always expressed times. 0.01 is a rate. P ratio always expresses times. How many times? 11.11 times. 11.11 times. Guys, clear? Now what is the answer? MPS equals to P ratio into EPS. P ratio 11.11 times. EPS 2.25. Answer? Rupees 24.99. You can take round of 25. Now what is the expectation? 25. If you buy up to 25, it is a worth to you. But what is the actual? Overvalued or undervalued? That's it. Guys, clear up? This is one case. In case 2, there is a second case is there. EPS. You can use EPS based growth model. EPS based growth model. So that also give a MPS answer. Now you can observe here. Value of a stock under PE multiple approach. PE, not PC, it's a PE multiple. Ratio also use the word similar word multiple. In inter level we are using ratio, in final level we are using multiple. So PE ratio approach, actual 35 rupees, return on equity 9%, EPS 2.25. PE ratio. How they calculated PE ratio, guys? 1 divided by return on equity. The answer 11.11 times. How we got MPS? EPS into PE ratio. Answer 25. What's your decision? Since actual stock price is higher, hence it is the overvalued. Sometime out of overlook, students will compare actual versus estimation. Decision will be reversed. If you compare with 25 to 35, it will give a overvalued. If you compare with 35 to 25, it will give undervalued. Don't confuse. What is the calculation you done? That is called estimation. That is the capability of you. You need to compare with your capability and actual. Okay, guys. Done. When coming to case B, guys, value of a stock based on earning growth model. So actual stock price 35 rupees. Return on equity is given 9%. So student here they are consider cost of capital instead of return on equity. Cost of capital is there now R 10.5%. If you take 10.5% is wrong for case 2. As per case 2, R is return on equity. Actual. So 9%. EPS 2.25. Growth rate 2%. Even though it's an overall question, growth model only. Now we have to convert that 2.25 into E1. Why? Because 2.25 is a current one. Now how it possible? 2.25 into 1.02 divided by R. Don't confuse. R is a return on equity. What is the R? 0.09. What is the growth rate? 0.02. Please tell me the answer. Rupees 32.79. So what is the capability or capacity of you? 32.79. But what is the actual? Overvalued only, na? More than our capacity. Okay. Take a break. After break, we will continue with the capital structure.
இது அதே தானே இருக்கும் நம்ம வாங்கின அதே மிஸ் பண்ணிட்டாங்க. நிறைய பேர் வந்து பாஸ் ஆகுறாங்க. ஃபோன்ல வந்து காஸ்ட் அதெல்லாம் ஈஸி பேசிடுறேன். நான் இன்டர் படிக்கும்போது இந்த மாதிரி படிக்கிறேன். அது வந்து ஃபர்ஸ்ட் நல்ல திமிரு. அதனால நம்ம பார்த்துக்கலாம். யூடியூப் அவர் ஸ்ரீலக்ஸ் அவர் ரொம்ப தெரிஞ்சு நல்லா இருந்தா அதுக்கப்புறம் எனர்ஜி ட்ரெயின் ஆயிடுச்சு. இன்னும் அப்பவே நினைச்சேன் என் ஃப்ரெண்ட்ஸ் எல்லாம்
Of Mahesh, I will cover SPM totally in EO, but it will available in our app, not in YouTube. Okay. So our next discussion. Yeah, sure, Mahesh. Even you are not listening the classes, you can purchase our EO class. So make sure you will get an exemption. Guys, please understand this problem. It's a CA inter-level problem. One adjustment I not covered in our board book material, board book problem. That's why I used this problem to understand that concept also. So observe the illustration number 26. So just for reference. So Arsenal Limited has the following capital structure, equity share, following capital structure. I already told. If they not specify the market value, it's a book values. Now equity shares, 10 lakh shares, 100 lakh is the capital value. Okay. 12% preference shares, 10 lakh is the book value. Retained earnings 120 lakhs, 14% debenture 70, 14% term loan 100. Total capital employed 400 lakhs. Now additional information is provided for the purpose of specific cost of capitals. Market price of equity share is given directly, P naught. Next, the next expected dividend per share is 2 rupees, D1 expected. And expected growth rate is 8%, that is nothing but G. The preference shares are redeemable after 7 years at par and currently quoted at rupees. What's the mean for 75? Not issue price, market price. So Chendu, BV part only afternoon session, maybe chapter 5 and some of chapter 6 content. Remaining all app only, not in YouTube. Guys, clear? Quoted means currently quoted or market price of both same meaning. It's an existing company. Market price. Quoted price means market price. P naught of preference shares. Debentures are redeemable after 6 years at par. Repayment value 100 rupees only, par. And currently market quote at 90 per share. That is nothing but P naught of debenture. The tax rate applicable to the firm is 50%. There is a no specification about please calculate KO as per book value, as per market value. You have to take an assumption, or your it's a small information, you can calculate both. The best. If you are not sufficient time in exam point of view, so remaining problems also lengthy problem, on that time write down the assumption at the top. I'm calculating KO as per market value is the assumption. Guys, clear? But if they're focusing on market prices, better to take an assumption market price. If they don't want a market price point of view, there is not a time. It's a not give market values. If they are providing market values, means their expectation also market value point of view KO. Guys, clear? Done. Now I calculated both book value as well as market value. In book value, there is a no complications. Sources, book value, weights, specific cost of capital, product, sum of product is known as KO. But when coming to the market value, there is one complication. I will give a clarity of that complication. First, go over the book values. Before book values, please figure out the specific cost of capitals. When coming to the specific cost of capitals, first KE, dividend growth model, I think. Information available only growth as well as dividend. So D1, they given 2 rupees, P naught 25 rupees, and growth rate 8%. If you use this in formula, you will get an answer 16%. KE completed. Rate and earnings is there. You have to figure out KR. You can observe the entire additional information. There is a no flotation cost. If there is a no flotation cost, means K is nothing but KR. If there is a no flotation cost and personal tax, K is nothing but KR. That's why KR also 16%. Next, estimation of KP. Redeemable or irredeemable? Redeemable. So write down the formula first. Figure out the values. 12% of the face value. That is nothing but 12 rupees. Preference dividend. Next, repayment at par. Repayment at par. Par is nothing but face value, 100 rupees. Net proceeds is not there. That's why we are considering market price. So instead of net proceeds, market price I consider. There is a meaning of NP equal to MP. 75 rupees. Number of years equals to 7 years. Now all information is available. So if you do this calculation, you will get an answer 17.7%. When coming to the KD, same redeemable, I think. I want interest. Percentage on face value. That's nothing but 14 rupees. Tax rate given in the question 50%. I converted into rate. Repayment at par, they specified face value. Net proceeds is not there. Market price is given 90 rupees. Number of years equal to 6. If you insert in the formula, you will get an answer 9.1%. Next, there is another topic called KT. Interest 1 minus tax. What is the interest? 14 rupees. 14% is nothing but take another some face value 100. There is a no face value, but calculation purpose we are considering 100. 14 into 50% tax, you will get 7%. That is nothing but rate 0.07. Guys, clear? Done. Specific cost of capital is completed. Observe this. 16%, 16%, 1.77%, 0.091%, 91, 0.07. Any doubt regarding this? Presentation purpose I consider is a initial. Why? Because in a single format I calculating book value as well as market values. Common sources first. Specific cost of capital also common. There is no change. That's why I will take it first. Now write down the book values given in the question directly. 100, 120, 10, 70, 100. Total 400. You can easily get weights. Capital divided by total, capital divided by total, capital divided by total, capital divided by total, capital divided by total. You have specific cost of capital and book value of weights. If you multiply these two, you will get an answer called product of book values. So product of book value total 12.58%. So KO as per book values. Guys, clear? There is no complication, easy. Now when coming to the book value, how you calculate market value of equity share capital, guys? Number of shares into MPS. Yes or no? No? Number of shares given in the question. How many shares? 10 lakh shares. Market price given in the question 25 rupees. Now what is the market value of equity share capital? 10 lakhs into 25. 250 lakhs. Use calculators. 250 lakhs. Clear? You are treating that market value of equity share capital equals to 250 lakhs. 250 lakhs is the market value of equity share capital. There is a separate of return earnings. There is a separate of return earnings. But the subject saying that what is the market price you have 25 rupees. That 25 rupees includes market value of equity share capital and return earnings. Very clear? That means this 250 lakhs is not a equity share capital. This 250 lakhs is known as market value of equity. That is the difference between equity share capital and equity. What is the difference? Equity share capital means only capital amount. Equity means capital plus return earnings. Are you clear? So this 250 lakhs includes market value of equity share capital portion, market value of return earning portion. You can't show separately. You can't show separately. But if KE, KR is different, you have to show separately. Guys, I got the logic now. If KE, KR both is same, there is no change in the calculation part. If KE, KR is different, when they are different? If there is a personal tax and flotation tax is given, KE answer is different, KR answer is different. On that time, you have to split the 250 lakhs into equity share capital portion as well as a return earning portion. Guys, clear? Sir, how I split the 250 lakhs into equity share capital and return earnings means with the help of book value of weights. With the help of book value of weights. Let us check this. Market value of equity share capital I required. It included in market value of equity. Are you clear? I want a proportion of book value of equity share capital divided by book value of equity. This is the way to split the 250 lakhs into market value of equity share capital. Now what is the market value of equity? 250 lakhs into what is the book value of equity share capital? 100 lakhs. What's the book value of equity share capital? 100 lakhs. Return earnings? 120 lakhs. Now, what's the mean for book value of equity? 100 plus 120. 220 lakh. This is the proportion we are using. Now, please calculate 250 lakhs into 100 divided by 220 lakhs.
$3.6.
113.636 lakhs. Out of 250, only equity share capital portion is 113.636 lakhs. Hope you guys clear? When coming to market value of return earnings, you can easily find out 250 minus 113.63, or when coming to the subject point of view, this included in market value of equity. I want a proportion of book value. Book value of retained earnings divided by book value of equity. Now, what is the market value of equity? 250 lakhs. What is the book value of retained earnings? 120 lakhs. What is the book value of equity? 220 lakhs. Answer? 136.364 lakhs. 250 lakhs completed. This split is not required every time. This split is required when KE not equals to KR. Guys, clear? If there is a no there is a no flotation cost, KE equals to KR. On that time, you go with the equity, direct 250 lakhs, or you go with the split. It will give same answer. But if KE, KR different, you have to split only. Give a correct answer. Are you clear? So keep in your mind, if you are calculating market value, go with the split. If there is a flotation cost, there is a no flotation cost, no issue. If you are calculating market value, you have to split. Are you clear? Sir, in a previous problem, you can observe there is a no retained earnings. Not required to split. When coming to this problem, there is a retained earnings of book value. If there is a book value, when you are doing a market value calculation, you have to split. Clear up? Done. Now you can observe the solution. 113.6, 136.4. 250 lakhs completed. Next, please calculate preference share capital. 10,000 shares, 75 rupees each. 10,000 preference shares into market price, 75. Answer? 7.5 lakhs. Debentures, 70,000 debenture into market price per debenture, 90 rupees. Answer? 6.31 lakhs. 63 lakhs. Guys, clear? When coming to what about our term loan? As per my knowledge, there is a no market values. Can I skip that? No. If you skip, you are losing a long-term capital. You are doing a long-term capital cost now. You have to consider all. That's why we are assuming that book value is nothing but market value. The total 250 plus 7.5 plus 63 plus 100, 420.5. Now weights you will get already specific cost of capital calculated. If you multiply with weights and specific cost of capital, you will get a product of market value. So the product of market value is 12.86%. Any doubt regarding this? Anyone? Sure. The intention of explaining this problem is split. Guys, clear? Split. Okay. So next, our important concept, capital structure. In FM, it is a chapter. When coming to BV, it is a concept. Clear, sir? Now, initially I used a word called, I want 100 CR capital. For my business purpose, I want a capital of rupees 100 CR. We have a 5 sources to procure that 100 CR. Yes or no? What are the proportion you want, you can use. Okay, but capital structure saying that as per your interest, please don't procure money. Are you clear? You have to procure money with the pattern, with the best version. If you procure money with the best version, that will give a benefit. If you procure as per your interest, it not benefit to your company. For example, here is a person name called Abhi. I said I want 100 crores. How you procure? He is saying that with help of equity share capital 20 CR, with help of preference share capital 20 CR, with help of debt 30 CR, with help of loan 30 CR, as per his calculation. Okay. Next, I provided to another person name called Mohan. Same, I asked the same decision. I want 100 CR. How you procure? He is saying that with help of equity share capital 40, with help of preference share capital 20, with help of debt 35, with help of bank loan 5 CR. This he's saying that this will give a beneficial to your company, but I don't know. When coming to another name, Charita. So same decision. She told that 25 CR equity, 25 preference share capital, 25 debt, 25 loan, total 100 CR. Next, my as I calculated my company point of view, if I want 100 CR, I prefer 50 CR with help of equity, 50 CR with help of debt. I'm not using preference, I'm not using term loan, I'm not using return earnings. I'm using only two things. One is equity share capital, another one is debt. My point of view, that is the best one. But we don't know which one is the best one. That's why we are learning capital structure. Guys, clear? Every person saying that this is the best, this is the best, but there is no proof. For a proof purpose only, we have to learn capital structure. Next, another person point of view, equity 50, debt 25, term loan 25. This is the beneficial. But out of 5 plans, you tell me which one is the best one. With the help of cost of capital, you have to figure out. For 5 plans, we need to calculate KO. I calculated. Then how you choose best one out of 5 plans? Which plan gives a low KO, that is the beneficial to your company. Guys, clear? If I am focusing on KO, I am not focused remaining all things. I just focusing on KO point of view. I calculated KO for all plans. 10%, 12%, 13%, 14%, 15%. Cost point of view, company expecting least 10% in a first plan. If company want to cost point of view best version of a proportion, go with the 20, 20, 30, 30. Guys, clear? Okay, done. Any other? Any other? Tax only for interest point of view, no? But I am talking about capitals. Yeah, exactly. EPS. Here I am not focusing on the cost. I calculate EPS for all plans. Which plan give a highest EPS? Not least. Highest EPS, that is the best plan. Any other? MPS. MPS also. I am not focusing on EPS, I am not focusing on KO. I am focusing on only MPS. I calculate MPS for all plans. Which plan give highest MPS? That is a best capital structure I have. Any other? What, sir? PV ratio is not suitable, sir. With the help of that only we are calculating EPS and MPS. So how to calculate PE ratio? MPS divided by EPS, na? So when coming to this, we can't figure out PE ratio with help of the capitals. With help of capitals, you can figure out MPS. With help of capital, you can figure out EPS. With help of capitals, you can figure out KO, not PE. Next, dilution of ownership. Dilution of ownership. Instead of loans, if you go with the equity, what happen your ownership? Dilute, na? Are you ready to dilute your ownership or not ready? Not ready. Where which plan give a less dilution, that is a beneficial. Guys, clear? Risk point of view. After dilution, risk point of view. So if you take a loans more, automatically your company facing a lot of financial risk. Why? Because irrespective of profits, you have to pay interest. Risk only, na? So I will find out the risk element where I got a least risk, that is a beneficial. Guys, clear up? Ownership point of view, risk. These two are theoretical concepts. MPS, EPS, KO are the problematic portions. Clear? So now observe this concept. Here capital structure means systematic composition of what funds? Long-term funds. The word they're using a word called systematic. So we can't bring based on discussion we have to bring with help of logic, with help of a proof. Okay. Now the systematic composition means the word optimum capital structure. What guys? Optimum capital structure. So the word optimum has the two meanings. Requirement point of view, maximum is the optimum. Not requirement point of view, minimum is the optimum. KO, what required you? Minimum or maximum? Minimum. Optimum means minimum. EPS, what you required? Maximum or minimum? Here also using word optimum. But what is the meaning for that optimum? Maximum. Guys, clear? Done. You can observe the optimum capital structure means KO must be low, risk must be low, EPS must be, that is nothing but maximum. MPS must be ownership, not dilute. Guys, clear? So after I will share these notes. Okay. Next, when coming to for proving this optimum capital structure, I already told risk and ownership are the theoretical concepts. KO, EPS, MPS are the problematic concepts. Now for proving that optimum capital structure, you have approaches as well as analysis. Approaches as well as analysis. Analysis point of view, there is no problems, but approaches point of view, they provided problems. Okay. Now when coming to the analysis point of view, EBID to EPS analysis, EBID to MPS analysis, indifference point analysis, and financial break-even point. Financial break-even point. These are the analysis we have. Just understand the names. You know, I think hope you guys know the income statement. Sales less variable cost, you will get a contribution, less operating fixed cost. You will get EBIT, less financial fixed cost called interest, you will get EBT, less tax, you will get a EAT, less preference dividend, you will get a EAESH. Very clear? The name itself saying that it is a proof of EPS calculation. EBIT less interest, you will get EBT, less tax, you will get EAT, less preference dividend, you will get EAESH, divided by number of shares, you will get a EPS. Don't start from sales to EPS. You can start from where? EBIT. That is much more enough. Now, P ratio equals to, what's the formula? MPS divided by EPS. P ratio they will give. EPS you already calculated. If you P ratio into EPS, what is the answer? MPS. That is called the EBIT to MPS analysis. Guys, clear? Huh? Next, there is a topic name called indifference point analysis. In this indifference point analysis, at particular EBIT, both the plans EPSs are same. At particular level of EBIT, both the plans EPSs are same. Meaning for this, I have this plan and this plan. Very clear? For assumption, if I earn 2 lakhs, this EPS equals to 10 rupees, this EPS is equals to 10 rupees. That is the meaning for indifference point. Generally, this will give a different EPS, this will give a different EPS. But if I earn only 2 lakhs, both EPSs are same. Now you have to figure out that 2 lakhs. That is the definition. At a particular level of EBIT, both the plans EPSs are same. Just assumption purpose, I taken 2 lakhs. The 2 lakhs you have to figure out. Guys, clear? Next, when coming to the another analysis name called financial break-even point. Financial break-even point. At particular level of EBIT, your equity earnings are 0. If equity earnings are 0, just take a basic example. If we earn 5 lakhs of EBIT, this is sufficient for interest payment, tax payment, preference dividend payment. If you settle this 5 lakhs to interest, tax, preference dividend, what about the EAESH? 0. 5 lakhs sufficient for what payments, guys? Interest 2.5 lakhs, tax 2 lakhs, preference dividend 50,000. What about the EAESH? 0. At particular level of EBIT, company equity earnings are 0. Are you clear? Now, That are the regarding to analysis point of view. There is a no theoretical discussion. There is a no theoretical discussion. There is a no problematic portion in our board material. Okay. As well as from last 20 attempts, they are not ask that kind of questions. That's why you can't focus more on that. When coming to approaches, this kind of questions they're asked multiple times. Okay. Now, if you understanding the approaches or if you understand the analysis for single thing called proving that what are the structure you have that is optimal. Now, when coming to approaches, guys, approaches are classified into two types: relevance, irrelevance. Relevance and irrelevance. The word relevance means market value change due to capital structure changes. Market value change due to capital structure changes. Previously, I followed 100% equity capital structure. My company have only equity. If I want money, I will procure with help of only equity. There is no debt in my company. But I am shifting to new plan, 50% equity and 50% debt. Previously, what is your capital structure? 100% equity. Now, what is your capital structure? 50% equity, 50% debt. If you shift from here to here, your market value also either increase or decrease. That is called relevant. Are you clear? When coming to irrelevance, if you shift from here to here or here to here, that means capital structure change. Even though your capital structure changes, market value remains constant. If market value changes, relevance. If market value remains constant, irrelevance. Why they are changing? Why they are not changing means because of capital structure. Guys, clear? Previously, we are following 100% equity capital structure. Now we are planning for equity plus debt. It means our company facing a risk. Are you clear? On that time, our market value either increase or decrease. That is called relevance. Even though we are facing a risk with the help of a debt, our market value remains constant. That is called irrelevance. For proving that sentence, you have 4 approaches. 2. Under relevance, net income approach, traditional approach. Under irrelevance, net operating income approach, MM approach. Guys, clear up? For proving the sentence, capital structure change or market value change due to capital structure changes. Net income approach, traditional approach. Market value remains constant even though your company capital structure changes. For proving that, net operating income approach and MM approach. Clear? Now, so there is some assumptions they are followed. Assumptions means it's not actual reality. Even though it is not possible, they are treating it is a possible. That is called assumptions. First one, market have 2 sources of funds. One is equity, another one is debt. But cost of capital, I told, we have 5 sources. But here there is an assumption. What is the assumption? Market have only 2 sources. One is equity, another one is debt. Guys, clear? Sir, you already told now 5 sources. Yes, I already told. But here they are saying that assumption. Next, guaranteed EBIT. What is the second assumption? Guaranteed EBIT. Sir, in cost of capital, you use your sentence. Calculation of KE is difficult than KD and KP. For that reason, you saying that uncertainty in profits. But now you saying that there is a guarantee EBIT. Profit is not in our hands now. Sometimes we will get a loss or sometimes we will get a profits. But there is uncertainty. But here is assumption, guarantee EBIT. If they saying assumption means yes, we have to say yes. Next, debt is cheaper than equity. So it means KD is less than KE. Why? Common sense. Who are the risk takers? Owners or debenture holders? That's why their expectation also. Debt is cheaper than equity. K is less than K is greater than KD. You can go and observe the problems also. K is always higher than the KD. Why? Because they are the risk takers, their expectation also more. Next, no tax. Focus on this. No tax. When coming to calculation part, they always specify tax rate. But here is assumption they are saying that no tax. Don't confuse here. just follow the thumb rule. They specify the tax rate, take a tax rate. If not specify the tax rate, just go with, leave about that. Guys, clear? Next, these all are not required, guys. And coming to the net income approach. Why we are learning net income approach? Why we are learning net income approach? We are learning net income approach proving the sentence market value change due to capital structure changes. Yes or no? No? Why you are learning net income approach? If your capital structure changes, automatically market value also changes. Let us check with an example. This company want 50 CR capital. They have two options. This company already following 100% equity rule. Previously, what are the amount they procured? All are equity only. Are you clear? Now, for this 50 CR, in market they have two options. Option 1, equity. Option 2, debt. Previously, I don't know. Previously, they followed one rule, equity rule. For that equity shareholders, they are providing 12% return. Now, common sense, if I procure this 50 CR, here also they are expecting how much? 12%. Existing shareholders expecting 12% means new shareholders also expecting 12% only. There is no change. But I already told in the third assumption, debt is cheaper than equity. Debt is cheaper than equity. It means option 2, as per option 2, what? Debt only, na? More than 12% or less than 12%? Nice, clear? Now see, if company opt option 1, KO equals to, for existing shareholder 12%, for new shareholder 12%. So for existing they have to pay 12%, for new shareholder also they have to pay 12%. Totally how much they need to pay? 24%. Already they have a 25 CR capital. For the 25 CR they have to pay how much? 12%. For a new capital how much? 50 CR. For that 50 CR also they have to pay equity dividend 12%. Totally 24%. Now, if company opt option 2, KO equals to KE plus KD. Why KE plus KD? Existingly 25 crores is there. For that 25 crores they have to pay 12%. Newly I am procuring 50 CR. With help of what? If I procured it, how much I have to pay? Total. How much? 22%. Clear? Now, just take an assumption. EBID of two firms, 2 lakh rupees. EBID of two firms, what's 2 lakh rupees. Now, market value of firm, I will give a clarity for next. Just as of now, just understand this. Market value of firm equals to EBID divided by KO, guys, formula. Market value of firm is total organization value find out. Now, as per option 1, for two options point of view, EBID is common. But option 1 point of view, what is a KO? What is a KO? 24%. Existing 12%, new 12%. What is your market value of firm? 2 lakh divided by 0.24. What, guys? 8,33,333. Okay. If you follow option 2, please calculate market value of firm. EBIT 2 lakhs, KO 22%, 0.22. Answer 990. Clear? Based on example, I understand one thing. If we say debt is a cheaper fund, if you rises, your KD decreases. Debt is a cheaper fund. If you rises, KD decreases. If you follow option 1, you have to newly pay 12%. If you pick option 2, you have newly pay 10%. That is nothing but low KD. If KD decreases, your KO also decreases. Option 1 24, option 2 22. If KO decreases, market value increase. 8 lakh, 9 lakh. Guys, clear up. Capital structure change from equity to debt. Yes or no? Market value also what happen? Change. Increase is nothing but change only, na? Proved up. Net income approach. So, debt is a cheaper fund. If you rise, KD what happened? Decreases. Now comparing to KE, KD what happened? Comparing to KE, KD what happened? Decreases. If KD decreases, KO what happened? What happened? If KO decreases, market value what happened? This is called net income approach. This net income approach followed by Vijay Mallya. Very clear, guys? The only basic principle they followed, debt is a cheaper fund. That's why they taken 9,000 crores from SBA. That's clear. For repayment, how much you know? For taking of a loan, 9,000 CR, roughly. I don't know the exact figures. 9,000 is I know. They sold their assets of rupees 14,000 crores by our financial minister Nirmala Sitharam. So in Bangalore, there is a Kingfisher Towers. On that Kingfisher Towers, he constructed one mansion worth of rupees 250 CR. He not lived even one day. At I think I don't know the exact number. Top of the building. I think 25th floor above. On that 25th floor above is a mansion. They sold for just 140 CR to one businessman. If you take a loan, not that much of easy to repay by, because that's why we are using a word called risk. Guys, clear? The followed a principle name called risk. They're just assuming that debt is a cheaper fund, debt is a cheaper fund. Guys, clear? Huh? So any doubt regarding this statement? Comparing to equity, which one is a cheap? Equity. If you go with an equity, KE 12%, new. Just have focus on about the new. Forget about the existing. If you pick option 1, you have to pay 12%. You have to follow option 2, you have to pay 10%. Comparing to debt, equity, debt is a cheaper fund. That's why I raised. Because of a rising of a debt, my KD what happened? Comparing to KE, my KD is low. 12, 10. Because of KD is low, my KO what happened? 24, 22 decreases. Because of decreasing KO, my market value firm what happened? 8 lakhs to 9 lakhs increases. Guys, clear? Huh? Done. When coming to the, this is a theoretical explanation. But when coming to the problematic point of view, market value of firm you have to calculate. So there is a concept name called capitalization. It's a concept name called what, sir? Capitalization. Just a basic, follow the basic formula. I taken some X amount from her. I repaid 10,000 as an interest portion. She asked, sir, how much percentage it is? I told 10%. Guys, clear? I repaid 10,000. She asked how much percentage it is. 10%. Can I find out the capital involved between us? How? 10,000 divided by market value of firm equals to 10,000 divided by 10%. That is nothing but 1 lakh. For the 10,000, my point of view cost. Her point of view profit. Return or EBIT divided by Q. EBIT divided by KO, capitalization. Sir, we have contribution, we have EBIT, we have EBT, we have EAT, we have EASH. These all are known as profits only. But why you are considering only EBIT? Are you got to my logic? Contribution also be known as profit. EBIT is also be known as profit. EBT also be known as profit. These all elements is known as profits only. Even though all profits, why you are considering only EBIT?
The cost of overall cost of capital that includes
Interest?
All part of the cost of capital. That's what you consider.
Okay, done. All interest, taxation, preference, student, all elements are included in that EBIT. That's why you have to consider that EBIT for the basic. I told one thing, that EBIT is also be known as overall profit. Is also be known as operating profit. Is also be known as business profit. When I doing a business valuation, which profits are beneficial? Business profit. Guys, clear? That EBT is known as taxable profit. That EAT is known as net profit. That EIASH is known as equity profit. That is the difference between all profits. So what is the overall or organization profit? EBIT. Sir, why you are considering KO? You can take KE na. You can take KD na. Why you are considering KO? If I find out in overall, what I want? Overall cost. That is a basic, that is a principle we are using for market value firm. EBIT divided by KO. Guys, clear? Now, sir, I have EBIT, sir. I don't have KO, sir. But they're asking market value of firm, sir. Can I figure out? I have EBIT information. I don't have KO information. Can I figure out market value of firm? How? Without denominator, you can't capitalize, na? I don't have a KO. Guys, clear? On that time, there is a second alternative calculation is there for market value of firm. Market value of firm equals to market value of equity plus market value of a debt. Market value of equity plus market value of a debt. You have only two capitals. Sum of two, value of two capital is known as firm value. Guys, clear? Now, sir, I know how to calculate market value of firm directly, but I don't know how to calculate market value of equity individually. Clear? Now, what is the rule you are using? Capitalization rule only, na? EBIT divided by KO. That talks about overall. But here I am using a rule EAESH divided by KE. Are you agree? EAESH divided by KE. Why EAESH divided by KE? Specific about the equity. Specific about the equity. Interest divided by KD. Interest divided by KD. Specification about the debt. Sum of specifications is known as a firm value. Based on information, you can pick either EBIT divided by KO or a market value of equity plus market value of debt. Clear? Guys, clear? Done. Come to illustration number 10. A limited, S limited are in the same risk class. Okay. I will give another clarity. As per professional words, we are using two kind of words. Levered firm, here firm represent company. Levered firm, unlevered firm. The word levered means risky company. The word unlevered means non-risky company. If company follow 100% equity, any risk to the company? Why? Because if I have a profits, I will give. If I don't have a profit, I am not ready to pay. But when coming to there is a debt, irrespective of profits, you have to pay. Na? That is called risk. If company have a 100% equity, that is called unlevered firm. If company have a debt plus equity capital, that is called levered firm, risky firm. Okay. Now see, A limited and B limited are in the same risk class and similar in every aspect, not respect, that is aspect. Except that A limited is a levered firm while S limited. What does it mean for that? A limited is a levered firm, S limited is under not S limited. Means for what? Two companies are similar doing a businesses, similar kind of manpower, similar kind of a machinery, etc. etc. But except in one thing, that is called risk. A limited have equity plus debt capital, S limited have only equity capital. That is the meaning for that sentence. Now, S limited is unlevered. A limited has a 12 lakh debenture. 12 lakh debenture. Not number, it is a rupees. It means market value of a debt equals to 12 lakhs. You need not to calculate. Directly they given. If not directly given, how to calculate market value of a debt? Interest divided by KD. Debenture worth carrying a 12% rate. Both the firm are earned 18% before interest and taxes. What is meant by 18% before interest and taxes? EBAD amount not directly given. They provided percentage. 18% of EBAD on total assets of rupees 22 lakhs. The 22 lakhs is not EBAD. On the 22 lakhs, 18% is a EBAD. Okay. Now, assuming a tax rate of 50% and a capitalization rate 14%. What is meant by capitalization rate? Capitalization rate of 14% for unlevered firm. What does it mean for unlevered firm? KE. That means for S limited, firm value equals to equity value. Next, calculate the value of both the firms using net income approach. See the presentation. So what I explained in notes, that is not shows a good presentation. Are you clear? So this shows a good presentation. So when coming to here, first we are start from the EBAD. We are figure out the EISH divided by KE. We will get market value of equity. Then add directly market value of debt. You will get a market value of firm. Are you clear? So if you want EISH, you have to start from EBAD. So EBAD 22 lakhs into 18%. 3,96,000, 3,96,000. Less interest. How much? 12 lakh into 12%. For both firm or only levered firm? Only levered firm. Which one is a levered firm? A limited. So that's why 1,44,000 only for levered firm. Nil for unlevered firm. So you will get an outcome name called what, guys? Taxable income. In assumptions, I told there is a no tax is assumption. Very clear? If you follow that assumption, right answer. If you not follow assumption, that will be right answer. If not follow assumption means what? You can deduct tax. For both cases, you have to maintain a clarity and you have to mention the assumption. What is the first assumption? As per assumption specified in capital structure theories, there is a no tax. If you write that sentence, you can't take tax deduction. As well, you can write like this. If there is a no tax is assumption, if they specify, consider. That will be another assumption. If you write second assumption, you can deduct tax rate. Both solutions are there. This is without tax deduction. In notes, I have a with tax deduction. Now see, because of no tax deduction, taxable income is nothing but EAESH. Sir, in between there is a preference dividend, na? But there is a no preference share capital. EBIT less interest, you will get what? EBT. Instead of EBT, they are using a word called taxable profit. Next, automatically we are deducting tax, but as per assumption, no tax is assumption. If they followed means there is a no tax. If there is a no tax means outcome is nothing but EAT, na? EBT is nothing but EAT. EAT less preference dividend. But what is the first assumption? Market have only two sources, debt and equity. Where is the preference share cap? No preference share means no preference dividend. That's why EAT is nothing but EAESH. That's the word they recorded. Taxable income is nothing but EAESH. Okay, guys. Now EAESH divided with KE. What is the KE? 14%. They said only for unlevered firm. But why you are considering in levered firm also? They consider 14% for unlevered firm. Why you are considering here? Same risk class. Same as similar in all aspects except risk class. Market value of equity 18 lakhs, 28 lakh 28,571. This is not a firm value. You have to add a debt value. Market value of debt for only one company, that is levered company. How much? 12 lakhs. Nil for here. So total value of the firm 30 lakhs, 28 lakhs. Guys, clear? Now please observe this. EBIT 3,96,000, 3,96,000. Less interest 1,44,000 nil. You will get taxable profit called EBT 2,52,000, 3,96,000. Less tax. In our material, I am not deducting tax. That has to be assumption. Here I deducted tax. Both are correct. When it correct means you have to mention the assumption. Guys, clear up? Don't confuse. As per assumption, even though there is a tax notes, no, ignore it is a no tax. Assumption. Okay? But they specified the tax rate means you have to follow another assumption to assumption. Clear? Don't go with the confusion criteria. Why? Because this two similar answers provided in our board book. Go with the one assumption. If the tax rate is given, follow the tax rate. If tax rate is not given, don't consider. Clear? So here market value of firm 21 lakh, 14 lakh, 14,286. Guys, clear? See, generally no tax is an assumption, but if specified by a problem, please consider. I consider. Next, another concept called traditional approach. So there is a no problems is there. Just it's a theoretical concept. Just it's based on word up to. Up to limit everything is positive. After limit everything is negative. Sometime up to limit everything is negative. After the limit everything is positive. Guys, clear? So as per net income approach, what happened? That is a cheaper fund. KD is decreases. KO decreases. Market value of firm increases. Are you clear? Every time if you are procuring with help of a debt, KD will be accumulate. First time it is beneficial. Second time benefit will be reduced. Third time benefit will be reduced. Fourth time benefit will be reduced. At 5 or 6 times if you procure only debt, one time it will increase more than the KE. Guys, clear? If K increases more than KE means KO what happen? Increases. If KO increases, market value of firm what happen? Decreases. Before limit, you told right. That is cheaper, KD low, KO low, market value of firm increases. If limit crosses, all will be reversed. Guys, clear? What is the relevance approach statement? If capital structure changes, change only, na? Either increase or decrease, I don't know. Change or not? Changed. Next, another one, net operating income approach. What's the next concept, guys? Net operating income approach. This net operating income approach, it's a discussion relating to what, guys? Irrelevance theories. Yes or no? No? In irrelevance theories, what we understand? Capital structure change or not? Market value remains constant. Now, so net operating income approach, MM approach. Net operating income approach is a theoretical concept, guys. Just it is a theoretical concept. There is no discussion. But you have to keep in mind one point. It's MCQ point of view. MM approach is a practical approach, problematic portion. Operating approach, net operating approach is a theoretical portion. Okay. Now, when directly you can understand the MM approach, Modigliani and Miller. So Modigliani Miller saying that market value remains constant, not as per what you told. Are you clear? In a net operating income approach, what they again express means you are focusing on debt. Why? Because it's a cheaper fund. If you are procuring that fund from the outside, you are taking a fund to another point called risk. If you have come to with the risk amount, existing shareholders will not continue. Are you clear? What you focus, that is a cheaper fund. That's why I'm procuring. You don't know there is another element name called risk. Existing shareholder will not continue. If we need to maintain them in our company means we have to increase their expectation. Yes or no? No. What the benefit you received in KD, you have to compensate there to equity shareholder. Benefit, cost. What happened? Set off 0. 2% benefit. I need to compensate that to 2% to KE. KD 2% decreases. KE 2% increases. KO what happened? No change. If KO no change means market value of firm also no change. KO decreases, market value of firm increases. KO increases, market value of firm decreases. KO constant, market value also constant. Guys, clear? Market value constant. That is a theoretical explanation given by David Durant. But he missed one thing, that is called investor mindset. Are you clear? Market value of firm purely depends upon the investor. If investor feels it is a good company, he will continue. If investor is not feel it's a good company, they will exit. If they will exit, market value will decrease. If they will continue, market value will increase. That is the basic principles. Guys, clear? For that purpose, they are using a concept name called arbitrage process. Arbitrage process. One of the toughest problem we have in chapter 5. Arbitrage process. Before that arbitrage process, you have to learn calculation part of MM approach. So MM approach is a practical approach. It focusing on the investor mindset. If investor will continue with the company, market value will increase. If he will not continue with the company, market value will decrease. Guys, clear? Now see, in MM approach, you have to focus 3 concepts. Value of unlevered firm calculation, value of levered firm calculation, and arbitrage process calculation. So value of unlevered firm, with tax concept, without tax concept. Market value of unlevered firm, with tax concept, without tax concept. Tax rate given, with tax. Tax rate is not given, without tax. Guys, clear? Now when coming to with tax, market value of firm is nothing but market value of equity. Why? Because which company it is? Unlevered firm. Now how you calculate this? EA ESH divided by KE or KO. Can I use KE is nothing but KO? Why? 100% equity. We have only KE. That is nothing but KO. Any doubt regarding this, guys? Okay, done. Now I have another doubt. How we get EA ESH? EBAT. There is a no interest. Why there is a no interest? There is a no debt. Unlevered form, na? Okay, done. So can I use EBT is nothing but EBAT is nothing but EBT? Okay, done. Can I reduce tax? Yes. Which concept it is? With the tax concept. Less tax. You will get what? EAT. Can I reduce preference dividend? Why? First thing, there is no preference share capital. Second thing, it is unlevered firm. Unlevered means 100% equity. Can I use the name EAT is nothing but EASH? That is a calculation I did here. Directly I deducted only tax. I not deducted interest, I am not deducted preference dividend. Why? There is a no debt because of unlevered firm. We have only two sources, that's why I am not deducting preference dividend. Are you clear? But business earning profit, that's why EBIT 1 minus tax. Guys, clear up? Next, when coming to without tax, same calculation or difference? Without tax, market value of equity. No change on that. EBIT is nothing but EBT, no interest. EBT is nothing but EAD, no tax. There is a no deduction of 1 minus tax. Guys, clear up? Done. These all are easy, guys. This unlevered firm calculation is easy. But when coming to levered firm calculation, you have to focus more. It's only not talks about total organization point of view. It's a talks about levered firm point of view only. Levered firm point of view. When coming to the levered firm point of view, without tax concept, with tax concept. In without tax concept, market value of levered firm equals to market value of equity plus market value of a debt. There is a no change in this. Market value of equity plus market value of a debt. You already learned in where? Net income approach. But when coming to with tax, guys, listen. Market value of a levered firm equals to market value of unlevered firm plus tax benefit. Market value of unlevered firm, tax benefit is nothing but debt into tax rate. Debt into tax rate. So these are the calculation we are using in with tax levered firm calculation. In a previous, I generally told interest has a tax advantage. I 1 minus tax. But here I recorded debt into tax rate. This is called calculation purpose. As per MM approach, with tax concept, we are calculating like this. First, you have to figure out what? Unlevered firm value. Then you can apply the debt into tax rate. Sum of these two is known as market value of levered firm. Very, very critical area. Remaining all are same. Any doubt regarding this? Illustration number 11. The following information is available about Blue Kit Limited. NOI 50 lakhs. That NOI is nothing but operating profit. That is nothing but EBIT. NOI is nothing but what, guys? Net operating profit. That is nothing but operating profit, EBIT or business profit. Next, tax rate. Debt capital 20 lakhs. Interest rate on debt capital 8%. Capitalization rate applicable to debt to free firm. What is meant by debt free firm? Unlevered firm. Is a risk class to which Blue Kit Limited belongs to 12.5%. Can I use the word KE? Unlevered firm, na? What should be the value of the firm according to Modigliani and Miller model? If it is a Modigliani-Miller model, you have to check tax rate is given or not. Tax rate is given. If tax rate is given, you have to figure out it is a with the tax concept. Now see, market value of levered firm equals to market value of unlevered firm plus debt into tax rate. This is a calculation. If you want levered firm, before that you have to figure out what? Unlevered firm. Market value of unlevered firm equals to, here also with tax, without tax. With tax, EBIT 1 minus tax divided by KE. Now what is the EBIT? EBIT, what's that? 15 lakhs. Tax rate, can I take directly 0.6? 1 minus tax divided by KE, 0.125. What is the market value of unlevered firm? $20. 72 lakhs. Huh? Now see here, I am not focusing on the unlevered firm. I have to calculate levered firm. If you want that levered firm, you have to do a working note for unlevered firm calculation. Now unlevered firm 72 lakhs. What is the debt value? 20 lakhs. What is the tax rate?
40%.
72 lakh plus 8 lakhs. 80 lakhs is a market value of firm. Guys, clear up? Done. Come to illustration number 12. The last problem we have. Unlevered firm don't have interest, na? That's why I am directly deducting 1 minus tax. Okay, guys. Come to the next concept. So this is another problem you have to understand. It's not required. If you want, and check with our notes. So next concept, arbitrage process. What is the next concept, guys? Arbitrage process. In arbitrage process, we are using a concept: selling share at high price, purchase share at low price. Are you clear? Basic common sense is there. If high price share, if you sold, that value of the company will be fall. If you invest that amount in low price share, this company value will be increased. At one point of time, what happened? Both will be same. Market value remains constant. Selling share at high price. High price share you have to sold. Low price share you have to purchase. That is called arbitrage process. At the gap between sold and purchase, you have to gain amount. That gain is known as arbitrage profit. Guys, clear up? Now, I have a two companies shares. One is levered firm, another one is unlevered firm. In levered firm, one fraud transaction has happened 3000 CR. Automatically shareholders will be panic. Automatically they will sold their investment in that company. Very clear? But as a potential investor, I understand, okay, it's not proved. Just it's a rumor happens. There is a CBI department, there is a tax department to prove the transaction. Up to now, I will hold. Very clear? At that time, what happened? 100 rupees share price when fell to 10 rupees. Yes or no? No? Because of that transaction, all remaining investors are went away. But when coming to another company is there, my company, that is 100 rupees. I am selling that 100 rupees shares. That amount I invested in these 10 rupees shares. That 100 will fall to 90, 80, 70, 60. This will be increased to 10, 20, 30, 30, 40, 50, 60. At point of time, both company shares, what happened? Market value constant. Guys, clear? Now, fraud in which company happened? Levered firm. Sometime unlevered firm also happens. So we can shift from levered to unlevered or unlevered to levered. Both will be possible. But here you have to follow assumptions. Okay. For example, first example, if you are shifting from unlevered firm to levered firm. Unlevered, I have a 10% ownership. I am selling that entire 10% ownership on that company. I will invest that amount in levered firm. Up to now, I don't have any risk. Right? You are at a unlevered firm. Now I am going to that company means I need to invest that amount in debt plus equity. What are the amount I received with the sold of that ownership? That amount I have to invest on two equity. I need to invest in equity as well as debt. That is assumption. When if you are shifting from unlevered firm to levered firm. For example, if you are shifting from levered firm to unlevered firm, if you are shifting from levered firm to unlevered firm, up to now I faced a lot of risk. Why? In levered company, I have a equity portion as well as debt portion. As a owner, I need to bear that risk. Yes or no? No. It means I am a capable for risk bearing because of levered firm. Now I am solding my investment in levered firm. I am shifting to unlevered firm. Even though I shift to unlevered firm, I have a capacity to bear risk. This much days I faced a lot of risk now. Future also I can bear easily. That's why I sold my ownership in this company. I am not receive any debt value. I can sold my ownership value, and you can procure money from outside as a loan. Why? Because you have a capable of taking a risk. Guys, clear? Now, sold of investment, you will receive some amount. For taking of loan outside, also some value added. If you have a more amount, you can invest more. If you invest more, you will get a more ownership. If you invest more, if you get a more ownership, you will get a more bonus earnings. Guys, clear? Clear? Levered to unlevered, unlevered to levered. I will explain again. Unlevered to levered. What are the amount you received in unlevered firm? You have to invest in both equity and debt in levered. Assumption 1. Assumption 2. If you are shifting from levered to unlevered, what are the amount you sold in levered firm, as well as you can procure loan risk amount from outside. You can invest the total amount in unlevered firm. Now let us check with the problem number 12. Consider the following information relating to two firms, RIL and SIL, which are similar to each other in all aspects excepting leverage. RIL 1000 is the equity share capital. Equity share capital. 600 is the equity share capital. Debt 0, 400. Net operating income, that is nothing but EBIT. 100, 100. Interest on debt 0, unlevered firm. 20, levered firm. Market value of equity 2000, 1000. You need to understand, market value of equity share capital is different, market value of equity is different. As a owner, you have a right on equity, not on equity share capital. Guys, clear? When you are sold means you are not selling equity share capital, you are selling your right on earnings also. Guys, clear? So you have to understand that 1000 is called equity share capital, 2000 is called equity. Now, show how an investor holding 10% stake in RIL can generate arbitrage profit by using a personal leverage. Generally, we have to figure out ROE, return on equity. Which company give a high return on equity? We are shifting from another company to that company. For example, SIL return on equity 12%, RIL return on equity 10%. We are shifting from RIL to SIL. If RIL is 12%, SIL is 10%, then we are shifting from SIL to RIL. That is a basic rule we are using for arbitrage profit. But in our material, they provided where we have to shift. If we have a 10% stake in RIL means we are sold at RIL only. If sold at RIL means we are shifting to SIL. Guys, clear up? Now, how much you are sold, sir? 1000 into 10% or 2000 into 10%? 2000 into 10%. That's the clarity you have to maintain. Equity into 10%. So they specify also. No, now specified stake. They're using the word called stake. Okay, then. How much you will receive? How much you will receive? 200 lakhs. You are investing the 200 lakhs in debt as well as equity. First, you have to figure out how much percentage of ownership you will receive. How I calculate that percentage means total capital of investing company, numerator investment amount. Investment amount divided by total capital of the investing company. So what is the investing company? SIL. How we get a market value of firm SIL? Total value means market value of a firm. How? Market value of equity 1000 plus market value of a debt 400. What is the total market value of the SIL? 1400. 1400. How much I am investing? 200. 200 divided by 1400 into 100. 14.28. This much of amount I invest in equity as well as debt. In equity as well as debt. Guys, clear? Now you can observe this net operating profit 100. Because of investment in total capital, you will receive 100 into 14.28%. Why? Because this 100, 80 rupees equity earnings, 20 rupees interest earnings. You are invested in two capitals, na?
Yes.
It means you can directly take 100 rupees into 14.28%. How much? 100 in EBIT into your percentage of new ownership, 14.28. Okay, done. Previously, how much you are enjoying? Profit? 10% your ownership on a profit of rupees 100. 10% of 100, how much? 10 rupees. Previously, I benefited only 10 rupees. Because of shifting, how much I receiving? 14.28 minus 10. That is called arbitrage profit. That is called arbitrage profit. Guys, clear? Okay, done. You can observe the presentation. Estimation of return on unlevered firm. Previously, RIL 10% of 100 rupees, that is nothing but 10 rupees I benefited. Second point, how will get how much we get 200. Okay, he will get 200 rupees if he sell his ownership in RIL. 10% stake. What is the equity value? 2000. He sold 10% na 200. Percentage of stake will get in SIL. How we get a percentage of stake? Amount of investment divided by market value of SIL. So 200 divided by 1400, I got a stake of 14.29%. Okay. Proportion of capital. That 14.29 I investing in equity as well as debt. How much I am investing in equity? 1000 into 14.29, 143 lakhs. Debt portion 400 into 14.29, 57 lakhs. Total amount of investment 200 lakhs. Because of investing in equity and debt, I have a I have a right to take interest. I have a right to take equity earnings. Now see, return on equity earnings in SIL. Because of equity investment, 80 rupees into 14.29%. Out of 100 EBIT, out of EBIT 100, I am reducing interest. There is a no tax. There is a no preference dividend. EBIT is nothing but EISH. So 80 rupees into 14.29, 11.432. Add return on debt. I invested in debt also, na? So 20 rupees into 14.29, 2.858. Total how much I received? 14.017. Previously, how much I enjoyed? 10 rupees. How much I benefited because of shifting? 4.29. Guys, clear? Instead of that, I said directly 100 into 14.29, 14.29 minus 10, you will get a 4.29. This is a presentation. Clear? Now we are shifting from where to where? Levered to unlevered. So they change the values also. Focus on that. Show how an investor holding 10% stake in the equity of SIL can generate arbitrage profits, assuming that market value of SIL is 2000. Previously they are saying 1000. Now it is how much? 2000. And RIL is 1000. RIL previously 2000. Now as per case B 1000. Don't confuse. Okay. Now when coming to the case B, first we have to sold the stake. How much we are solding, sir? 2000 into 10%. 2000 into 10%. That's a mistake everyone doing. Observe. The market value means market value of equity plus market value of a debt. The 2000 is there, na? Market value of SIL. What does it mean for market value of levered firm? Market value of equity plus market value of a debt. When coming to unlevered, equity is nothing but value of the firm. There is no doubt. Lot of students are confusing that point only, sir. Out of 2000, you have to reduce debt portion. How much? 400. You will get a market value of equity 1600. You can sold the 10% on 1600. How much you will receive? 10% of 1600, 160. There is assumption. If you are you already in a levered firm, you have the capable of taking a loans outside also, no issue. Are you clear? You have a 10% ownership means you are bearing 10% of risk. On what value? Debt value. For what is the debt value? 400 into 10%. How much? 40 lakhs you can bear from outsider. Guys, clear? Now what is the total investment you have? 160 stake value, 40 outside loan, 200. You can invest the 200 on SIL. What is the SIL market value? Not 2000, 1000. 200 divided by 1000. How much stake you will get? 20%. Are you clear? Because of only equity, entire bonus earnings they will share. There is no interest. So 100 into 20%. How much you will receive? 20 rupees. Previously, how much you are enjoying here? Real?
14 point.
No. That's a case one. In 10%, na? 10% of 100 rupees or 80 rupees or 20 rupees. Previous SIL profit. Only 80. Why? Because you stake only in equity share capital. 80 into 10%. How much? 8 rupees. Are you clear now? Now 20. Previously 80. What's the benefit? 12. 12 is the wrong answer. Why? Because you are take a loan 40 lakh from outsider. They can't give for free. They're expecting something. You have to pay interest now. Are you clear, guys? 40 into interest you have to pay. Sir, interest rate not given in the question, sir. So, but there is a clue. 20 lakh is the interest value. 400 lakhs is the capital value. We can figure out the percentage. I think 5%. 40 lakhs into 5%. 2 lakhs. 20 lakh is the new earnings. 8 lakh is the old earnings. I have to pay interest 2 lakhs. Total net how much I receive? 10 lakhs. Because of shifting, I am receiving a profit of rupees 10 lakhs. That is called arbitrage gain. Hope you guys clear? Now let us check the presentation. We will close this session. So as per assumption, if you shift from the levered to unlevered, you can borrow amount from open market, risk associated with your ownership. So estimation of arbitrage gain if investor shift from SIL to RIL, return on SIL previous 8 lakhs. Okay. Amount we get from SIL if we sell 10% stake, 160 lakhs. If you sold your stake, 160 lakhs. So there is an assumption you can take a loan from outside, risk associated with your ownership, 40 lakhs. Total investment in hands in investor, 160 plus 40, 200 lakhs. If you invest 200 lakhs in SIL, how much ownership you will get? So percentage of stake we will get in a RIL. Investment into market value of RIL 20%. Arbitrage gain calculation. Return on RIL. That is nothing but new company profit. 20% of equity earnings. What are the net profit, net operating profit they given? That is called equity earnings. 100 into 20%, 20 lakh. Interest on interest amount. Why I am deducting interest means? So because of assumption I have taken a loan from outside. Risk associated with the ownership. 5%. That 5% is I already said how they provided 2 lakh rupees. 18 lakh is the new benefit in the company. New benefit in the company. But when I calculating a difference between new and old, that's why I'm reducing old company earnings. Old company earnings 8 lakhs. How much again benefited? 10 lakhs only because of shifting. Guys, clear up? So this is called arbitrage process. So these are the financial management problems concepts we have in your board material SPM. All basic versions, all intermediate level models are completed. So next afternoon session we start with the chapter 6 methods and approaches. Max they will give 2 questions in exam point of view. Sometimes they will ask only 1 question. Guys, clear? Okay guys. Sir, how written on SIL is 80 lakhs? So net operating income means EBIT guy. EBIT. So EBIT is 100 lakhs. On that EBIT, first you have to deduct interest amount 20 lakhs. You will get EBT 80 lakhs. There is a no tax rate. That's why EBT is nothing but EAT. There is a no preference dividend. That's why EBT is nothing but EAT. EAT is nothing but EISH. That EISH is nothing but owner's equity, owner's earnings. Okay, if I have a 10% stake in that SIL company means I have a right only on equity earnings, not total earnings. The equity earnings are 80 lakhs. My stake is 10%. That's why I will receive 80 lakh into 10%, 8 lakh rupees. And okay, guys. So we will continue afternoon session. So we'll start at 2:30. Okay. Thank you. Bye. So all YouTube students, I can request afternoon there is no live session guys, so if you are interested to join my classes, please contact this number 83093533726. Thank you.